Hi, and welcome to those who've joined early. It's only 5 to 1, so there's still time for others to join. Hope everyone's ready and got what they need to start.
So welcome everybody, all of those who've joined. We're still waiting for quite a number to join us. We'll start at 5 past, whether we have the full house or not at that stage. Others will just have to catch up. Of course, the recording is always available after the session. We'll do official welcome to Dr. Munir Hassan at 5 past, and then we'll start. So if you've got time to go and make yourself a cup of tea or coffee, don't know if you've got time to make lunch, but if you have, then please do, and we'll start thereafter. Thanks.
Hi, Danny speaking.
Okay, so welcome everyone to this pleasant afternoon. Hopefully we're seeing the end of the rain according to the Weather Bureau in Johannesburg anyway. I'm always a little nervous when I see words like implications. I don't know what's missing and what I've overlooked anywhere. So I'm intrigued to find out, Munir, what's in store for us. And stranger to our sessions, and thank you everyone for joining us. And thanks, Munir, for giving up your time and educating us. So without further ado, we will have a break I presume at about 2:30 for about halfway, if that's in order. And Mania, the floor's yours.
Thanks, Stan. Thank you. Just to test that I am coming through loud and clear. So good
Yeah,
afternoon.
for me,
Good.
it's good.
The sound's good. No, thanks, Stan. So good afternoon, colleagues. Good afternoon to everybody. It's been a while since I last joined joined this group and had a presentation here. Life gets quite busy. Even I thought in academic world it's actually quieter, but you just shift your working hours to late night. That's what seems to happen in the academia in the academic world. So it's interesting also. I looked at some of the participants and I recognize some of those names as well. I see some names from the past that I've engaged with you guys back in the day when I was still at SAICA and head of tax over there. But it's interesting to see some of the names. So yeah, nice to connect with you guys again. When I put together when Danny asked me to look at a topic for this discussion this afternoon, and you guys are stuck with me for the balance until 4 p.m. We will have a break for about 10 minutes just to refresh ourselves sort of midway through, like Stan said. I looked at all the sections or topics rather that I lecture on. And I looked actually for the most difficult topic that the students grapple with, and I said, okay, this is a topic that I'm sure that will be beneficial to the practitioner group as well, because I put a lot of thought into what would be appropriate for the discussion this afternoon. So I hope this afternoon what we're going to achieve is I've taken a difficult topic. Stan said, go and get a cup of coffee. I think take a double shot on that, because we are discussing a rather difficult topic this afternoon, which is the tax implications of leases and leasing arrangements, which is, like I said, it's quite a difficult topic, and a lots of sections that we need to get through. We need to look at the VAT implications, the income tax implication. There are also capital gains tax implications that one needs to consider on these leasing transactions. So it's a particularly difficult topic, but what I hope to achieve is hopefully that what I'm going to do for you this afternoon is I'm going to present it in a simplistic manner. So that's what I hope to achieve this afternoon. So that's the topic. If we just then look at the agenda, what we're going to have a look at, we'll start off light. So the operating lease is the easy one. We will get through that, and we'll start off with the operating lease, and then we'll look at the lease premium. What is the tax implication of a lease premium? And we'll then get into the more difficult stuff as we migrate into the lecture. So leasehold improvements, which it's got its own set of rules we're going to see this afternoon for value-added tax purposes, as well as for income tax purposes, and even CGT purposes are or needs to be considered. And then with every lease arrangement, the moment you get deductions, the principle of leasing is that where there are deductions, and it's the principle of the Tax Act, that for any capital allowances where you get a deduction, if there's some kind of ability to buy that asset back, or some kind of benefit that you get again in terms of cash flows, there's going to be a kind of a recoupment. So we're going to cover the lease recoupment arrangements for lessees, and a possible lease recoupment that triggers in the hands of the lessee as well. And then we'll deal with the concept of finance leases. So we'll step away from the more easier operating lease and get into the more heated stuff of finance leasing arrangements, and what is the tax implications of those transactions, which are particularly complex as well. And then just to close out, what I like to do is, because there's a lot of confusion, and there's a big differentiator between how we deal with a leasing transaction versus a suspended sale arrangement. I like to also deal with the suspensive sale arrangement, the tax implications of that, and then contrast it to a leasing arrangement as well. So we're going to basically close out with that toward the back end. So that's the agenda, guys. That's what we're going to basically be dealing with this afternoon. We'll start off with the operating lease, which is a simplistic one. And how do you differentiate? How do you how do you actually know that this leasing arrangement is an operating lease? Because that's the first question that one needs to answer, is that how do you identify that I'm actually dealing with this kind of operating lease? And the trigger is, remember, the lessor is the owner of the asset. So the lessor has full right of ownership. Title deed is in the lessor's hand. And what the lessor then does is he leases this out to you for the rental payment that you're basically going to pay him. So he's selling you, if you think about it logically, he's selling you the right of use. And in return, you're paying him that monthly lease premium. So that is a leasing arrangement. There's no finance cost. So the key differentiator we're going to see later when I come to the finance leasing arrangement, that in finance leasing arrangements, we do have the concept of interest coming through. And I'm going to just differentiate between the two transactions and show you that you can pick this up between the fact that you're going to pick up finance costs that's going to come in a finance lease, where we don't see this with an operating lease. So this is a typical rental agreement, which you guys will see in practice. That's a common example of what is an operating lease. So if you think about it, what's first? The VAT implications, let's deal with that, and then we're going to go to the income tax implications accordingly. So the lessor is the owner of the assets. Remember, he's the one that has a title deed. So don't forget that for tax purposes. But before we even get into tax purposes, or income tax purposes rather, let's sort out the VAT. So what is the VAT implication? We have a special rule, which I don't really think it's such a special rule in itself, because we all know that when it comes to VAT, the general time of supply is the earlier of invoice or payment, right? When we look at leasing arrangement, we've got a special rule, and it basically says that it's the earlier of when the rental is due in terms of the rental agreement or contract, or when the payment takes place. Now think about it. Obviously, typically you don't have to invoice the person monthly, because the contract is going to suffice as the invoice for even your purposes of claiming input tax on that rental arrangement. So the actual lease agreement will stead in fast and be the substitute for the tax invoices. So obviously in that lease agreement, it's going to spell out when the lease is when the monthly lease rentals are due, and the earlier of that date, or the payment date, is going to basically trigger the time of supply for the lessor. And obviously, once we've triggered that time of supply for the lessor, it then opens up the opportunity for the lessee to claim an input tax deduction accordingly. Remember, we still need to test specific requirements in terms of the tax or the VAT legislation for the lessee to be able to claim that input. So the moment we triggered the time of supply, we're going to have an output tax triggered for the lessor, and the actual value is going to be based on that lease rental payments. Obviously, now, with the VAT change and the rate change, it's still up in the air. We normally would have applied the tax fraction of 15 divided by 115 to the rental payment that you actually receive, and you'll declare that as the lessor as output VAT. Now, with the new tax fraction, it's going to become a little bit more tricky, because we'll have to go 115.5 divided by 115. So, it's going to become a little bit more tricky. We're going to have to factor in for that decimal point as well until next year, that we then get to a round figure of 16%. So that's the tax implications in the lessee's hand, in the lessor's hand. Let's then deal with the income tax in the lessor. We just dealt with the VAT implications. We know that the lessor is going to declare output tax on any rental that he receives. What is going to happen with the income tax implication? Now, remember, I said that the lessor is the one that has title deed to this asset. So that lessor is the one that's actually going to be entitled to capital allowances, if any, on the asset. So obviously it depends on the nature of the asset. If it's a manufacturing asset that you're leasing out, for example, then the lessor can get a Section 12C allowance, because he's leasing the asset. If it's, for example, a commercial building that's been rental, then Section 13 Quin would be applicable, and the lessor would be entitled to that allowance accordingly. But it is very important that we're not looking at the we differentiate and we identify the correct taxpayers, because if we mix up the taxpayers, we're going to get the tax implications totally wrong. So it is a lessor that's entitled to the capital allowances, and obviously on the monthly rentals, what the lessor is going to then do is he's going to declare gross income into his gross income, the net rental ex VAT, because the VAT was merely collected on behalf of the revenue authority and paid over to SARS accordingly. So that 15% now 11 or 15.5%, which will go up to 16%, is a collection on behalf of SARS, and you pay that over, and the balance is going to go into gross income. So this is all very simplistic stuff just to get ourselves in the mind thinking. Let's then look at the lessee side of things. And Danny, I did say that if there are any questions, I'm happy to deal with them as we go along. Don't wait till the end. So if you've got burning questions as I'm dealing with the lecture, please stop me. You're welcome to ask questions. It's better that we deal with it while we're dealing with the issue, so that we don't have to circle back at the back end and re-come to that thought process that we're busy unpacking. Then let's look at which we now change in focus. We're moving from the lessor and we're coming to the lessee. We're into a different taxpayer. Remember, the lessee is the one that's actually paying the rentals. The lessor is the one that received the rental. So we change in taxpayer now at this point, and we want to know what's the VAT implications. Now, the thought process with VAT, and this is not only what I'm showing you here actually sticks to, and it's a logical thought process that you should be applying in your practices with any input tax deduction that you claim. The first question that you ask yourself is, with any input tax deductions, is this a denied input? Because if this is a denied input, remember, you can't actually get any input tax deductions, right? Now, in this case, we are obviously entitled to input tax deductions on the rental, because the lessor would have actually paid the output tax, and the lessee is going to basically get the input tax deduction. So the first question you ask yourself, can I actually get the input tax deduction on this? If this is a denied input, for example, if it is an actual motor car I'm buying, you know that you can't claim an input tax deduction on the motor car as defined. That's your first question that you ask with any input tax deduction. Once you pass this test and you know that it is not a specific denial in the VAT Act, the next question you ask yourself is, how did I use or apply the asset? And if I use the asset 100% for taxable supplies for enterprise purposes, you can claim the full input tax deduction. If you've applied that asset for mixed use or 100%, let me first deal with that situation, 100% in exempt entity. For example, you're using a computer that's only used to make taxable supplies or generate taxable supplies of the letting of residential accommodation, which is an exempt supply. In that case, that computer, you can't get any input tax deduction at all, because it's 100% applied for exempt purposes. If the asset is applied for mixed purposes, which means across the board, you guys are very good in that. You're accountants, you know that you want to apply the apportionment ratio. And this is where you will seek a SARS approved apportionment ratio. The default approved apportionment ratio is the turnover-based method, but there are other more complex methods you can apply to for SARS, depending on the industry that you work in. Now, where apportionment becomes an issue is obviously where you've got mixed supplies. So you need to be careful if your taxpayer VAT vendor is making both taxable and exempt supplies. That's the trigger to see immediately that there could be potentially an issue of apportionment that we may need to consider. So coming back to the lease, the operating lease, remember we're still dealing with an input on the monthly rentals that the VAT vendor has actually paid on leasing this equipment. And obviously the question is, first, can I claim the input? You'll probably pass that. The next question is, how did the user apply the asset? If it's 100% taxable supply, claim the whole input. If it's exempt supplies, 100% used for exempt supplies, you claim nothing. And if it is a mix usage, then you'll fall back to the SARS approved apportionment ratio. Very important, just remember that there's something that we call the de minimis rule in the VAT Act, which basically says that if the SARS approved apportionment ratio is 95% or higher, you claim 100%, no need to apportion in that instance. And then the last point, don't forget, guys, this is the one that SARS always sketches you guys in practice on, is that you need a valid tax invoice. I mean, you guys learned that in like first year or second year varsity, but that's the important point when it comes to input, claiming an input tax deduction. You need a valid tax invoice, and here the agreement will suffice, and it's going to be the substitute as for the tax invoice, and it can act as a valid tax invoice in this instance. So very importantly, important point also that we see come through from the VAT system is that invoice and documentary proof, particularly on the input tax side, becomes particularly important for SARS audit purposes. You don't see this kind of documentation requirement, interesting enough, when it comes to the income tax side of things. So, for example, if you don't have a valid tax invoice, it doesn't mean you can't claim a deduction on the income tax system. We just need Section 11A just asks you for any amounts incurred in the production of income. Nowhere that it says valid tax invoice. But yet, when we contrast VAT to income tax, we see that VAT is very prescriptive and very documentation driven because of the audit trails that we basically need to have in place. And obviously, as you guys know, you guys are auditors as well, so that it ensures that SARS can actually track these documents through and ensure that obviously the output is triggered on the other side as well. So let's then have a look at what about the lessee, where the lessee actually is leasing, then a motor car is defined, right? Because we know if we buy a motor car, if you actually acquire a motor car as defined, you can't get the input tax. I think we all know that. It's a denied input. But what happens if you are renting a motor car? You, the lessee, you actually leasing from Avis that motor car, and it's for enterprise purposes. In this case, it's very important that if we look at the wide ambit of the wording in the VAT Act, it doesn't say that buying of a motor car is denied. It actually says the supply of a motor car is denied, and therefore supplies include the hiring out of the motor car. So it's very important that, and SARS actually confirms this, that as a general rule, input tax deductions may not be claimed by a VAT vendor if it falls within the definition of a motor car, as it does, even if it is used in the course of making taxable supplies, regardless of the mode of acquisition. For example, the motor car could be acquired by way of outright purchase, importation, or lease agreement, or even the operating rental agreement as casual hire. So what they simply saying is a car hire is also denied. So be careful as well, because this is the one that SARS is going to try and come catch you guys in the practice, where they're going to say, well, this is an operating lease. You're going to want to claim that. You're going to see VAT on that. Avis is going to charge you the VAT on the output because they're a VAT vendor and they're making a supply. For them, it's an output tax trigger as a lessor. But remember, you as a lessee, the first test I told you is, can you get the input? And in this case, because it's car hire, you can't actually get that input tax deduction. So this is one to just be careful about and just to be on the lookout. I remember back in the day when we worked at SARS, we looked for instances like this where we went and we looked at, audit clients where they claimed this kind of things. And what SARS would simply do is they would then go 5 years back, because prescription in the VAT Act is for 5 years. If they catch one of these invoices, they're going to go 5 years back, plus penalties, plus interest. And then, it's a small amount, but suddenly when you do that over a 5-year period, it can become quite astronomical as well. So that's just something interesting. I've done my PhD also on the VAT Act. Interesting that is where my passion lies. And something that I picked up in my PhD when I compared our VAT system to the New Zealand VAT Act. And I think there is something, at some stage we need to make some kind of submissions to SAICA as well. But we in South Africa have this concept of blatant denial in the VAT Act. So motor car, club subscriptions, entertainment. So what SARS is basically saying, and the policy point or the policy stance they have taken is that, you know what? We don't know how to audit this stuff. So we don't know whether the motor car is actually used for business purposes or private purposes. We actually can't differentiate that. So you know what we're going to do? We're just going to deny the whole input. We won't allow you any VAT input. Now that's a little bit insane, isn't it? Because there's definitely, when you buy a car and you're actually using it for business purposes, we don't have this test even in the Income Tax Act. Remember, when you buy a motor car and you use it for business purposes, we don't say you can't get any allowance or tax 11E write-off on it because it's a motor car. But from the VAT side of things, they're very strict. They're actually blatantly denying you. They're saying, hang on, even if you can prove that 100% you use this motor car for enterprise and for business purposes, we're not negotiating. We're just going to deny that input. We're blatantly denying it. And what's interesting is, in my analysis, when I looked at the international comparatives, New Zealand, and my supervisor was actually from New Zealand on the PhD. He mentioned this to me and he said, Munir, I find it very odd that you guys have this concept of a blatant VAT denial, full denial in the VAT Act. In New Zealand, they actually have what they call partial denial. So in this case, SARS is saying we can't make the differentiation. We're too lazy to actually determine whether there is some kind of business or private use and even audit it and come to that ratio, which is going to blatantly deny all these inputs, even though you have the proper invoices in place and everything may be in place. So it's very interesting. This is something I think that must be reconsidered at a particular point in time, because it's a very hard stance and a hard rule. But you know how SARS is. They are sore losers. So they make things the way they want it and the way it benefits them. So then let's have a look at the income tax, guys. We've just dealt with the VAT implications in the hands of the lessee. Remember, we're still in the hands of the lessee, the guy that's paying for the right of use of the asset in terms of an operating lease. So what is then the income tax implications? Simply put, he's going to claim a deduction. The lessee is going to get a deduction under Section 11A. And obviously, this is ex-VAT, because the VAT, we claim there's an input tax deduction if we're entitled to it. Then at the end of the lease, and I'm going to circle back to this, there's whenever we have a lease that comes to an end, remember, if the lessee got some kind of deductions, and the principle of allowances or deductions is that when we get allowances, and if at the end there's some kind of recoupment that takes place, or we sell the asset, if you think of an allowance asset, we claim allowances. At the end of the term of that asset, we sell that asset. What do? We write some of those allowances back, and we have what we call a recoupment. And you guys know, because that's an asset, you can also calculate CGT accordingly. Now, the similar principle is going to come through here. We're going to see that because the lessee was entitled to deductions, here's 11A deductions that's going through the income tax over the term of the lease. If at the end of the lease, the lessee has an option to buy the asset or actually continue leasing the asset at a very low rental, you're going to see that we're going to have a special recoupment that's going to come through under Section 8.5. So this is not a general recoupment provision under Section 8.4A that you guys do all the time in your tax comps for the asset on asset recoupment. This is a very special leasing the recoupment that I want to cover when it comes to an end. So we will circle back to this. For now, just be aware that at the end of the operating lease, if something happens, there's a possibility that we're going to get what we call a Section 8.5 recoupment that we need to consider in the hands of the lessee. Okay, so what we've dealt with in this opening session, which was actually the lightest part of the lecture, believe it or not, is just the operating lease. We've dealt with both the VAT and the income tax implications in the hands of the lessor, as well as in the hands of the lessee. So you know what is the VAT and income tax implications of an operating lease, if I had to ask you then. So let's then step off operating leases and come to this concept of lease premiums, because the VAT Act specifically and the Income Tax Act specifically deals with lease premiums and the concept of lease premiums. And let's have a look and unpack both the VAT and the income tax implications of a lease premium. Now, before we get into the detail, let's just step back and ask ourselves, big picture, what's a lease premium? So lease premium is something that you pay in addition to rental income. So obviously, it's particularly common in the shops. If you think of the shop malls that you enter into a leasing arrangement with, before you actually can sign that lease, the normal the lessor in those malls will normally ask you to actually pay as a lessee an upfront lease premium. Right, that's something totally different and distinct and a separate transaction to the actual leasing of the asset for the right of use of the asset. Like I told you, the lessor owns the stuff. He's got title deed and he's selling the right of use of the asset to you. And in the return, you're going to pay him monthly rentals. But lease premiums are something very disconnected and something very different. We find it in practice in the leasing arrangement industry, in the rental industry. You'll pick it up in your clients as well, where you see sometimes they have to pay this top-up premium before even they can start leasing this asset. It's a down payment. It's normally a round figure, 100,000, a big number. And it feels immediately, guys, it feels like it's capital in nature. So let's not even get there. Let's first deal with the VAT implications before we can even get into the income tax implications. So let's look at what is then the VAT implications of a lease premium. We see that because of the wide definition of supply, the word supply and services, and we're looking now from the lessor side, that this is a supply. It is actually read into the definition of a supply because of the wide definition of the word supply, and it's also read into the definition of services. So the simple implication is there are VAT implications on lease premiums. The lessor is actually going to have you charge your output tax on that lease premium, which is separate and a distinct event to the leasing and the rental of the asset. And the lessee can then claim an input tax deduction accordingly. Again, remember the thought process that I've actually given you. Test it again. Is this a denied input? Probably not a denied input. Yes, I can get the asset or the deduction, but don't forget, how did I use or apply the asset? And lastly, do I have the valid supporting documents to claim the input tax deduction accordingly? So even with lease premiums, there is going to be an implication on the VAT side, and quite simplistically put, the lessor is going to declare output tax, and you as a lessee on the premium payment, you can basically claim a corresponding input tax accordingly. Now, let's have a look at then what is the income tax implications. And I touched on it briefly when I told you that, hang on, guys, this feels like quite a big transaction. It's a once-off transaction, all indicators of capital in nature, isn't it? It feels, it smells like it's capital in nature. So if this is capital in nature, then if we test it against a general deduction formula, we're going to see quite simplistically that we can't get deductions of a capital nature for the lessee. However, we see what we have in the Income Tax Act is a special allowance or deduction. Now, remember, the way the Act has been designed, the Income Tax Act, is that all deductions of a capital nature is blocked immediately under 11A. But then what the Act immediately does is it gives you specific deductions for specific capital deductions and allowances. So don't think that automatically, if you can't get a deduction under 11A, that you are prohibited from claiming a deduction. Go and look in the Income Tax Act and find. Generally, there is going to be, and there is always some kind of capital allowance that you can actually get on that asset. In rare instances, we find that we can't get in capital allowances. One of the examples is, for example, on goodwill. Another example would be land. As you guys know, the Tax Act doesn't give you any deductions on those capital assets. But even with the lease premium, we see that the lessee is going to be entitled to a deduction, and it comes through under Section 11, small f of the Income Tax Act. What about the lessor? Immediately we discussed it. We all said that this feels like capital in nature. It smells like capital in nature. Therefore, it's on all probability a capital receipt, isn't it? Now, if it's a capital receipt, we know that the general gross income definition says excluding items of a capital nature. You don't pay tax on items of capital nature. You pay capital gains tax on that, isn't it? So for income tax, we're not going to include it. However, we get a special catch for lease premium under gross income paragraph small g. So if you look at paragraph G, it's going to specially catch it, and it's going to say lease premiums paid to the lessor is specifically included. Even though it feels like a capital receipt, it is going to be specifically pulled into your gross income definition, and it must be taxed accordingly. So simplistically, even though this is capital in nature, we see an allowance going to come through for the lessee, whereas a lessor is going to have to pay income tax on it accordingly. Again, we did discuss this before, but what is a lease premium? It's simplistically put, be careful when you look at the arrangements, because this is really something that we're paying in addition to the rental income. That's how you pick it up as well. Let's have a look then at the lessee and what can the lessee actually claim. So the deduction is going to be spread over the lease period. So we're going to look at the actual lease period itself, and the maximum deduction is going to be spread over, or your denominator cannot exceed 25 years. When can you claim it? You can claim it when it is paid. So you need very rarely, whenever the act, I always say this to the students as well, whenever SARS gets nervous, they go, we'll see it again, and I'm going to cover one of the sections as well when we deal with the suspensive sale arrangements. You'll see when SARS gets nervous, what they do is they go to payment basis. All right, so generally, similar to accounting principles, the VAT Act, the Income Tax Act, it's all based on accrual basis. So actually incurred, you don't have to pay to get a deduction. You don't have to actually pay to get the VAT input. You can actually just you just need an invoice to get the input. You don't have to make nowhere in the VAT Act it says it needs to be paid to get the input. It's just you need a valid tax invoice. So you need incurable of expenditure. But I always say like I say to my students, whenever SARS get nervous, they like to go to the payment basis. So here's a typical example of where we see that they want physical payment. So if you want to claim a capital allowance in terms of the lease premium, guys, you want to make sure that you can only get it if you paid it. You can't say actually incurred and you can claim it. And then obviously with any asset class, you see that throughout the Act, it's a principle of capital allowances that you can only start claiming it when you use the asset in that year. So you can't, if you park in the asset over there, you can't actually get allowance. You must physically start using that asset. So I just want to cover 2 points on this. The one is practical issues that may come into play with the lease premium. The one is regarding the renewal periods and indefinite lease terms. So what happens if you have an option to renew the lease, or if there's an indefinite term, what are we going to divide our denominator here by? Because we don't have an actual lease period. In that regard, what we're going to look at a reasonable, the commissioner will actually approve, or he will consider what is considered a reasonable in terms of that leasing arrangement. So obviously, if you have an indefinite period, for example, if it's common clause, that if it's a long-term leasing arrangement and 20 years is the common leasing period, then our denominator is going to obviously be 20 years in that regard, and that's what will then be accepted by the SARS commissioner. Then very importantly, also just to deal also with early termination of the lease and what happens upon early termination of the lease in regard to lease premium. Now, remember, I just stated this earlier, that we need to use the asset. We need to pay, guys, and we need to use the asset. So if you stop using the asset, if you early terminate, remember, you're in the lease agreement, you terminate early, but you had paid this premium upfront at the beginning of the contract. What's going to happen? Because you stop leasing the asset, you can no longer claim the deduction under 11F because you're no longer meeting the scope requirements of meeting that deduction and of claiming the deduction because you failed to use the asset. Yes, you may have paid for the asset, but you have failed to bring the asset into use at that particular point when you early terminate the lease, and therefore you will not be entitled to any further deduction. This is not written into the Act, by the way, the early termination part of it. This is sitting in the interpretation note SARS is issued on Section 11F. It's a lengthy one. It's probably about 50 pages or even longer that basically deals with it. But just to bring some of that interpretation into the Act itself, that to remember, if you early terminate on the lease premium, you stop claiming the allowance as well. Then if we just moving ahead, we now basically we dealt with the lessee. And remember, we dealt with the VAT implications up front. Lessor pays the full output, lessee claims the full input on the lease premium. And the question now is then, so what happens? And we also just dealt with the income tax implications of a lease premium in the hands of the lessee. That lessee is going to be entitled to a Section 11F deduction, and we've dealt with the scope and the implications of that accordingly. Then now let's turn to our focus to the lessor. And remember, I told you that even though this is capital in nature, what we are going to do is that we're going to specifically catch it into gross income under paragraph G. So we're going to basically include it into taxable income, gross income as a lessor, the premium that is received now from you as a lessee, and we're going to tax that. We're going to basically pay income tax on it. However, what the Income Tax Act then does is it actually gives the lessor a deduction under 11 small h. So there's a full inclusion, and then there's a deduction that comes to under 11H. Now, generally, the deduction that you get under 11H, it uses a present factor. So you won't be entitled to the full value, but what it does is it looks at future rentals, and if I can simply put, or the whole premium itself, and then it uses a discounting factor to actually get the deduction to today's value. Particularly with the lease premium, you probably will claim the full deduction because you've actually paid that amount right now, up front. But normally with lease rentals, what 11H does, it looks at all the future rentals, discounts it to present value, and gives you that deduction under 11H. So typically, the long and the short of what I've put in here on the slide for you is that the lessor is going to basically pay tax on it, but he's entitled almost to a full deduction. If you test it under 11 small h, then he's going to get an immediate deduction. But what's important for you guys, I think more importantly, because you want to claim the deduction, you don't want to pay tax on it, and you're going to use 11H on the premium to claim the deduction, is when does 11H then not apply? So in certain 3 instances, we're going to see that Section 11H is not applicable, which means that you can't get a deduction, which again means that you're going to pay income tax on the premium as a lessor. So if you've got a lessor that's actually charged a premium to a lessee, be careful for this interaction with Section 11 small h, where you want to actually claim the deduction. So the first instance where they can't claim a deduction, instance number 1, is where the lessor has more than 50% of the lessee. Right, so we almost looking at connected parties here. Something funny is going on. SARS is not happy, and therefore they get nervous. What they do, they don't give you the deduction under 11H. The next incidence where we see it come through is where the lessee now holds more than 50% in the lessor. So the other way around. Again, we've seen this concept of potential connected persons coming through. They're not happy. They don't give you the deduction. And the third instance that we see this coming through is where a third party now holds an interest in the lessor or an interest in the lessee, and that happens to be more than 50%. So even if we have a third party arrangement, so the moment we see somebody holding more than 50% in the lessor, lessee, whether it's third parties, whether it's a lessee, whether it's a lessor, get nervous because there's potentially the deduction under 11H is then not going to be applicable. And the implication of that, if we circle back to the slide again, we're only going to have an inclusion into gross income for your client who's going to be the lessor, and he's charging this big premium. So he's going to basically pay income tax on a capital receipt, which can be a big number, obviously, times 27%, which will come true accordingly. Okay, guys, so what we've dealt with, I think we've done pretty well. We've basically dealt with the operating lease. You can now do the VAT and income tax implications of an operating lease. You can also do the lease premium. So if you see a lease premium in practice now, you should have enough knowledge to basically carry you through. And you know the VAT implications, you know the income tax implications for the lessor, for the lessee as well. And you can now deal with the lease premium. Now I'm going to basically migrate to something that gets even more interesting and complex, which is then leasehold improvement. So it's quite often in the market space that what would happen is when you have a leasing arrangement that the lessee determines that, this building that you basically lease to him or the property that you lease to him, it doesn't quite fit his requirements in practice. So what he does is he starts doing improvements, right? And he does improvements technically to your property as a lessor. Now, remember, you are the lessor of the asset. So remember this principle, and that's why I want to deal with the big picture at the outset of leasehold improvements. And I keep stressing that the lessor is the owner, the title deed is owned by the lessor. The lessee is just paying you that rental for the right of use that the lessor is selling to him on a monthly basis. So it's actually what we call a bare dominium, and the use of it's two assets here that you can split it into. The one is the ownership. Because the lessor has full right of ownership, he has right of use and he has the title deed. But what he does is he splits it into two, and he says, hang on, what I'm going to do is I'm going to sell you the right of the use, and I'm going to keep the ownership with me. And in the return, you're going to pay monthly rentals for actually using the asset. Right now, that principle is very important when we come to leasehold improvements. Both we're going to see on the VAT side and the income tax side. It actually goes all back to this fundamental principle that I've told you about what is, in essence, legalistically a leasing arrangement. So let's have a look, and let's then deal with the income tax implications for leasehold improvements. The first important point is that there are VAT implications when the lessee undertakes leasehold improvement on property or land or buildings of the lessor. Know very well that we have specific VAT sections that's going to actually tell us how to deal with this leasehold improvement and what are the VAT implications accordingly, separately for the lessee and separately for the lessor. Now, I've alluded to this as well before, but you're going to see this come through. That even in my PhD, I uncovered this, that the VAT Act, and this is the whole issue of my PhD, is that the VAT Act is actually a scattered, and it's actually a mess to read it, and it's a very complex piece of legislation, overly sometimes complicated because of the scatter and because of the amount of sections that one needs to consider in relation to a single transaction or event. It's all over the show in the Act itself. What we see even more surprising here is that your starting point of inquiry with regard to leasehold improvement is not in the hands of the lessor, the person that actually owns the asset. It's in the hands of the lessee. So we're going to start off the point of inquiry, the investigation of the VAT implications in the hands of the lessee first, and then only we can determine the implications in the hands of the lessor, and we have to do it in this order. Otherwise, it will not make sense. You're going to see once we get to it. Now, before I can even deal with anything that deals with the concept of lease improvements, it's important that I first deal with this concept of what do we do, or what happens where we have a mixed use asset before it is supplied, right? Because remember, I told you that one of the points of inquiry when you buy an asset, the first question we ask is, can I get an input? Is it not denied? If you cross that argument and you can get the input, the next question we ask, how did I use the asset? And where I tell you use that asset for mixed usage, you used it for both taxable and exempt supplies. We discussed it, and I told you can get a portion of the input subject to the SARS approved apportionment ratio, which is based on the default basis on the turnover based method. So generally you can actually get that. But the question that I'm dealing with here is what would happen if you subsequently now sell an asset where you had mixed use? You only got to claim the portion of the input. Well, the simple answer to that is that apportionment always belongs to input, never to output. There's only two exceptions to that rule. The one is indemnity payments and the other one is fringe benefits. Other than that, we never ever apply apportionment ratio, that SARS approved apportionment ratio, to output tax. We're applying it to input, guys, all the time. All right, so the two exceptions is indemnity payments and fringe benefits. And if you have to ask me also, you should have been asking me, but why do we only have it on those two? Well, those are the two most common transactions that there's a deemed output trigger on in the VAT Act and in practice, and therefore SARS want to keep the balance in sync between input and output. But generally, as a rule, that only applies to input. So one day when we sell an asset where we use it for mixed use, you're going to declare VAT on 100% of the selling price. You're not going to only declare on 60%, even though you may have only claimed a 60% input. The rules of the VAT Act don't permit you to actually do apportionment on the output. So you can't say, hang on, I only claimed the 60% input. Therefore, when I sell it one day, I'm going to actually declare 60% of the VAT to SARS only because I want to balance the act automatically. What you have to rather do, you're going to see that we have a section in the VAT Act that achieves the sense of balance for you when you sell that asset, and it ensures that you can actually claim that input tax deduction as a correction, the 40% in my example, if we stick with it, that you were not previously entitled to, you can now claim that input at the point of sale. So let's have a look. We've got an asset. What happens with this asset? We use it for mixed supplies. So we're using it in the VAT enterprise. I want you to see the circle as the VAT enterprise of the VAT vendor. And we're also using it for non-tax purposes, for example, in the exempt division. Obviously, what we are going to do with it, we're going to claim a portion of the input, which is calculated then on the apportionment ratio. One day when we sell the asset, we're going to levy VAT. So when it leaves the enterprise, so we got our input, but we got a portion of the input only. When this asset subsequently leaves one day and through sale, or other exit of the enterprise itself, we're going to levy VAT at 15%. Or if it's a standard rated supply, is for example, it's the exportation of a good, then it could have VAT still, but it will have VAT at 0%, but it does still carry VAT. So we will not be able to levy only on 60% or 40% of the value. We're going to have to charge VAT on 100% of the sale when it actually exited. But it's not fair because we were only entitled to a portion of the input when we bought this asset. Yet when we sell in the asset, we're going to have to declare a VAT on 100% of the sale price. Now, what Section 1638 is going to do for us is it's going to fix this distortion and this mismatch, and it's going to basically bring back things into VAT balance. So let's have a look what 1638 does. When we sell any asset that was used for mixed use before it is supplied, we charge VAT on 100% of the selling price. However, at that particular point, what we can then do is we can claim an input VAT adjustment for the non-taxable, for the exempt supply application, i.e. the portion where input was not previously allowed. So how do we do that? We've got a formula going over here in 1638. We're going to have A times B times C. A is the tax fraction, which is 15 divided by 115. As you know, it may go now up to 15.5 divided by 115.5. So it's becoming a little bit complex in terms of the decimals that we're getting into the tax fraction. B is the lesser of cost. Very importantly, your cost for accounting purposes is normally X of VAT. But here the Act is very prescriptive and it tells us that cost here is a cost inclusive of VAT. So it's cost, but cost including VAT or the open market value, we're taking the lesser of. And I can give you this rule in the VAT Act, whenever you claim in a deduction, the rule in the VAT Act is always going to be the lesser of, because SARS wants you to get less of the money. When it's output, it's always the greater of two numbers because SARS wants a greater number. So you can go test this rule. You can test it, the principle throughout the VAT Act. You're going to see that that's where how to draft this is actually draft the Act accordingly. Whenever you're dealing with input, no, it's the lesser of rule. When it's the output, it's the greater of rule that you're going to see coming through. And then obviously C is going to be the portion of non-taxable or exempt usage that you can claim. So that's the formula that we're going to run. And that is going to be the input tax adjustment that we can basically get when we sell an item. So let's have a look at some numbers. Let's actually make some sense of it. I think it's a lot of theory that we've just been going through. Let's just deal with some numbers and a short example that we can bring it all together and make sure you are understanding and you're following the thought process. So a VAT vendor purchases a computer system costing 57,500, and it is including VAT, which is used for 60% exam and 40% is used for taxable supplies. The apportionment percentage was determined, and we used the turnover-based method at the time of acquisition, and the VAT vendor correctly then deducted only 30,000 of input, which is actually 40% of the input tax deduction that he's entitled to. 2 years later, the VAT vendor sells a computer for 46,000, including VAT. What is going to be the implication? So I told you the first implication is that we never apportion output tax. We're going to have to declare VAT on 100% of the selling price, which is going to be 46,000. And we're going to declare it on that purchase price that I basically received. If we circle back, there was a 46,000 that I sold it to, including VAT. So we're going to apply the fraction and we're going to pay output tax of 6,000. All happy with that. Because I've sold an asset that was previously applied for mixed use and I had to declare 100% on the selling price, I'm now at the point of sale entitled to an input tax adjustment correction. And how do I calculate that? I'm going to use the formula that I taught you, which is a tax fraction times the lesser of the costs or the open market value. Remember, if we circle back, what did I buy this for? I bought it for 57,500, including VAT. That's my cost price. My open market value, I sold it for 46,000. Remember, we're looking at the we're looking at the greater of rule over here. So we're going to basically then claim the 46,000, which is going to be, sorry, it's the lesser of. So even I'm getting confused. So in this case, we are claiming input tax. So because it's input, it's the lesser of two numbers. And in this case, we're going to take the lesser of 57,500 or 46,000. The lesser of is 46, and therefore we claim it on that. And we're going to now unblock 60%, because if we circle back, remember, we originally only claimed 40% input. Now on the selling price, we're going to basically be entitled to another 60% input, and we can claim 3,600. All happy with me. This is an important principle that I had to display to you. You're going to see it's going to make sense now when we go into further details of the actual lease improvements. So to circle back, what we're still discussing here is a leasehold improvement that the lessee undertakes on property or land of the lessor. But it was very important for me to first display or make sure that you understand the principle of a mixed-use asset before we sell a mixed-use asset, because you're going to see what's going to happen is that this principle is going to come into play when we actually look at the implications in the hands of the lessee. So generally, we have what we call adjustments, and our VAT adjustments are basically all catered for in Section 18. And there are two types of broad VAT adjustments that one can have. The one is what we call a change in use within the business, and the other one is a change of use outside, outside of the business. So I'm just going to deal with firstly or touch on VAT adjustments, where you basically have change of use adjustments, but outside the business. So generally, the general change of use adjustments tells us that if we buy something, if we buy an asset, and we're going to use it for enterprise purposes, which is I wanted you to see the circle as the VAT enterprise, as I told you earlier. So if I buy anything and I'm going to use it in this enterprise, I get a full input tax deduction. But if I acquire the asset other than through normal acquisition or purchase, so I never bought the asset, there's still a potential that I can get an input tax deduction. For example, I take a computer at home and I bring it into use in the VAT enterprise. So I haven't bought the asset, I previously bought it. Now I take the computer and I move it over and I bring it into this VAT enterprise. What is going to happen? Section 18.4 gives you an input tax deduction that you can basically claim on the computer. Similarly, if I sell an asset, generally when I sell an asset and the asset leaves the enterprise business itself, I declare output on the sale, isn't it? That output is going to be declared at 15% or it's going to be declared at 0% if it's a zero transaction. So very importantly, generally, when I say sale of goods and services, I declare output when it actually leaves the enterprise. But if the asset leaves other than through normal sale of goods and services, be very careful. For example, if you donate an asset, even trading stock, you previously got an input tax deduction when you bought a trading stock. If you now donate that goods, that there could be an output tax adjustment in terms of Section 18.1. So this whole concept of adjustments, what it does in the VAT Act, it tries to achieve a system of balance between input and output all the time as the VAT system is going along. And the change of use adjustments that I've basically dealt with in terms of output or input in terms of Section 18.1 or 18.4, it takes place on the day that we change of use, or we bring in the computer, or we donated the asset. That's when we're going to basically have this change of use adjustment. Another practical example is where we could have an output tax adjustment is if a VAT vendor takes some trading stock home. Think about it. He previously got an input tax deduction when we bought the trading stock. If he had sold the asset, he would have actually paid output tax on it. Now he takes it home. Section 18.1 is going to catch him and is going to basically ensure that there's still going to be output tax on that asset that is then taken for home consumption. So be careful and make sure that for every input normally, there's going to be a corresponding output, even if you don't know of it in the VAT Act. I can assure you it does sit there somewhere. So how do we calculate this change of use adjustments? If we have a look at the Section 18, how do I calculate that output tax adjustment? If I just circle back, we said it's on the day, so we're looking at any asset that leaves the enterprise other than through sale of goods and services. For example, you took the trading stock home, or you donated the asset. The calculation is going to be based on the open market value of the asset taken out of the enterprise at that particular point in time. And we will apply the tax fraction, because open market value for VAT purposes is a defined term, and it is inclusive of VAT. When we refer to open market value, we look at the open market value including VAT, and therefore we will apply the tax fraction to calculate the output tax trigger accordingly. Now, what about the input tax? Input tax is, again, we find a special formula in Section 18.4 where it says now it's A times B times C times D. You know that when we had the Section 16.3H input adjustment, we stopped at C, so it was A times B times C only. We got a further D coming into play here. So if you take any asset from home and you bring it into the VAT enterprise, this is the section that is going to give you the ability to claim an input on that. And this is the formula you will use to calculate the input tax that you can get as an adjustment, input tax adjustment. A is a tax fraction, B is a lesser of cost or open market value. Remember, we're claiming input, that's why it's a lesser of. We're looking at lesser. And C is the percentage of use. So if you're going to use this 100% of taxable supply, C is going to be 100%. But if it's 60%, it would only be 60% of the use. And D is the percentage of extent of payment if it happens to be a second-hand good. Now, when we're dealing with second-hand goods, SARS gets very nervous, guys. So, you know, and I told you when they get nervous, what happens? They go to payment basis. So we can see immediately what's happening over here. They're no more on invoice basis. They want to trace and follow the actual payment. And that's what they want to actually achieve over here. So what they're doing is they're only giving you the deduction to the extent that you physically made the payment. So if you've paid the whole amount upfront, then and you paid for the computer and you now bring it into the business usage asset, into the VAT system and enterprise, you can claim the whole input tax on the lower of cost or open market value times 15 divided by 115. But if I only paid, physically paid, I bought it on credit and I only physically paid 40%, then I can only times this by 40% because there's still 60% that's outstanding in terms of the payment of that asset. So again, we see this principle come through in the VAT Act, which is when, like I say, when SARS get nervous, we simply go to what we call the payment basis. So let's then have a look at this concept of of apportionment. We've now gone through, I've basically showed you an input tax adjustment and an output tax adjustment. I want to now see that you can actually apply this in practice in a short working example so that you can pick it up as well in practice. So Mrs. H is a chartered accountant. She has her own practice like you guys, and she's a registered VAT vendor under category B. You know that she's going to file 2-month tax returns every February and every 2 months later. She bought a computer for the business in January this year for 5,750, including VAT under cash sale. So she paid for it physical. Mrs. H derives all her income from the making of taxable supplies, and she accordingly deducts 750 in her Feb VAT return of this year. In Feb this year, she now decides to upgrade the office, and she takes the computer home for her children to use. And the open market value of this computer is now then 2,300. What is going to be the implication? So remember what's going to happen initially when she basically bought the computer. She would have been entitled to an input tax of 750. Now when she takes it home, she's exiting. She previously was entitled to an input tax deduction. When she takes it home, on the day the time of supply is triggered, and the output tax trigger is going to be the tax fraction on the open market value. So if we circle back, what we see is exactly an 18.1 adjustment taking place. It's the output tax adjustment, and it's on the day of the supply, and it's on the open market value. That's the number we're going to drive off. So we're going to take the open market value times 15 divided by 115, and we're going to have an output tax adjustment that comes through. So the principle is that be careful if you have this concept of where other than normal sale of goods and services in the VAT Act, where things are happening and things are moving other than to a normal sale of goods and services, or something is coming into the VAT practice, the VAT enterprise, other than to normal acquisition of goods and services, you are potentially implied title to an input tax when you buy those assets or you move it across into the enterprise, or when it leaves the enterprise, you may not know of it, but there's going to be potential output tax triggers as well that actually happens. Now let's take the same example and extend it a bit. Assume that Ms. H also earns dividend income. If that's the case, dividend income is not a taxable supply in the VAT Act. It's an exempt supply. Well, it's a non-supply. It's not even exempt. So it's not actually dealt with in any of the exemptions. So this is something that we call a non-supply. There's no VAT considerations. SARS has approved an apportionment input ratio of 80% because she earns dividend income. And in the practice, she's got taxable income. So she's got mixed supplies. And we know that when there's mixed supplies, generally we're going to use a turnover-based apportionment method, and you're going to claim a portion of the input accordingly. The VAT consequences would have been as follows. Remember the time and supply when she actually when she took this computer home to use it at home, there's going to be a deemed output tax adjustment. And remember what I taught you is that we don't apply apportionment to output. We only apply apportionment ever to input. So what we're going to have to do is we're going to have to declare output tax on the open market value on 100% of that value. And we're going to declare output tax accordingly paid over to SARS. But because we are now dealing with an asset that was previously used for mixed use, and now we supplied that asset and we actually left the enterprise and we had to pay output tax on the asset leaving the business. At that particular point, what is going to happen is that that vendor is entitled to a 16.3 input correction. And what's going to happen is because previously they would only have been entitled to 80% input, on the sale they can unblock that further 20% in the formula A times B times C. So A is the tax fraction, B is the lesser of costs or open market value, inclusive of that, obviously costs, and C is the extent of non-taxable usage again. So we see this concept coming through nicely in this case as well. If we then basically look at another example, just to to make sure you understand both the output side of things and the input side of adjustments. If B is a VAT vendor and they carry on a business of letting a residential property, guys, the letting of residential property is an exempt supply. And obviously, in this case, they're only making exempt supplies. They can't register for VAT. But if they decide to use one of the houses, which costed them 1.1 million plus 50,000 in transfer duty to operate as their offices in his commercial letting business. Now, the commercial letting of business of property is a taxable supply, and the value on this date is 1.8 million. If we just circle back and just look at the picture, what is happening is that we're actually taking something from an exempt supply, the letting of a residential accommodation, and we're moving it into a taxable supply. We are therefore entitled to a Section 18(4) adjustment, input tax correction or adjustment when we do that. And how we're going to calculate it, we're going to basically do the adjustment on the day of the change of use, and the calculation is going to be based on A times B times C times D. Remember, it's a little bit of an extended formula, and I can get an input tax deduction accordingly. So let's have a look at the example. Remember, so we moved an asset from exempt to residential or commercial letting, which is a change of use from exempt supplies to taxable supplies. What we're going to do, the time of supply is going to be on the day of the change of use, and the value is going to be the actual tax correction times the lesser of the costs, including VAT, or the open market value, or and remember, C is going to be the percentage that I used it for taxable supplies. And if we assume that we actually paid 100% for the property, then D will be 100%, because D is the percentage that are actually paid in the case of second-hand goods as well. So let's have assume that in this case we actually paid for the whole amount and we are using it 100% for taxable supplies. In that case, we can unblock 150,000 as an input tax deduction. So that's just the basics of adjustments that I needed to create context for. We remember to circle back, to come back to the discussion for the afternoon, actually, is to circle all the way back now to leasehold improvements, where you undertake a lease, the lessee is undertaking leasehold improvements, and what is then the VAT implication. So I had to go through this concept of adjustments because they all interact and they all interlink with what we're going to discuss. I cannot deal with Section 18C without having gone into the detail of adjustments, and therefore it was necessary for me to first actually deal with the concept of that adjustment. So big picture again, let's come back to what we discussing again. We're dealing with leases. We are dealing with the lessee making an improvement on the lessor's property for no consideration. Now, what is a VAT implication when that happens? Section 18 capital C is going to tell us what's going to happen, but very important, I want to stress that this is only going to be, or we only meet the scope of Section 18 capital C when we have a leasehold improvement for no consideration, which means that the lessor didn't pay us anything to undertake that improvement. Because if you think about it, if I undertake a leasehold improvement for a consideration which the lessor actually pays me for, then I don't need the VAT Act or special rules in the VAT Act to tell me what to do. There's an actual supply of a good and there's a payment that's coming through. So then I know how to deal. It's a normal time of supply, the normal VAT implications, value of supply rules. The output is going to basically be claimed on the lessee, who's actually, I'm actually going to be receiving that amount. What's going to happen in the lessee's end is he's going to have to declare output tax, and the lessee is going to basically, then the lessor is going to have to basically claim input tax, a corresponding input tax, because there's a payment then going from the lessee to from the lessor, sorry, to the lessee to effect the leasehold improvement on his land. So again, in that case, remember, I'm stressing that the scope implication of Section 18C, what I'm going to deal with now, is where you did not get a payment. If you actually got a payment, we don't need to worry about these sections. Why? We use basic the basic time and the value rules of the VAT Act to navigate, and we will actually determine the VAT implications that correspond accordingly. So we don't need to know anything further, because there's a physical payment that takes place for goods that is actually being given. And again, remember the principle that I started off with when I discussed the concepts of lease arrangements is that, remember, as a lessee, if I go and build a property on the land of the lessor, 20 years later, I pack up my bags and I leave the building behind and I walk away with my bag only. So what has technically happened on day one is that there has been a disposal of that building, that improvement that I've put in on your land, to you. So you've actually inherited, and you own the legal title to the land. You therefore now own the legal title to whatever's attached to it, which is the building. Therefore, I've supplied something to you on day one. I've given you this asset, and you've paid me for that asset. And therefore, I'm going to have to declare output tax on that, and you can claim a corresponding input on the payment. So it's as simple as that. But can you see that it's so important to understand the logistics and the legality of a leasing arrangement transaction to be able to unpack what we've actually just discussed over here. So that is the general rule. What I'm going to now come to is a specific rule in the VAT Act, and that deals with Section 18 capital C. And this is where the lessor does not make any payment towards you for effecting improvements on his land. So let's have a look what's going to happen. The scope is that when the first, as I told you, the starting point of inquiry of a leasehold improvement is in the hands of the lessee. We start off when we first test the scope. The scope of the section says where we have a leasehold improvement for no consideration, important, because if it was a consideration, I've already showed you the VAT consequences, and the lessee uses that improvement for mixed or 100% taxable supplies. So they don't talk of exempt supplies over here, they talk of mixed. And therefore, it was important for me to deal with adjustments or 100% taxable supplies. What is going to be the implication? The implication is that lessee has a deemed output tax at null value. And that's in Section 8.10.28. It's a special value or supply rule that we see come through. And the implication is, or the time of supply of that null value is actually when the improvement was completed. And that comes through in Section 829. Now, earlier I told you that the VAT Act is scattered. Now think about this. How would you ever know that you need to go to Section 829 when you're dealing with a lease improvement, because it's not in the index anywhere? How would you ever know you need to go to Section 8.10.28 when you're dealing with a lease improvement? It's not, like I say, in any index. You're not going to find this in the Act anywhere. You're going to have to just be a specialist to actually pick these things up. But the principle that comes through, so that is one that I wanted to show you, the scatter in the VAT Act and a number of sections that one needs to consider when actually dealing with the simple transaction of a lease improvement. And nowhere in the index it tells you that this is the section one needs to look at when you're dealing with leasehold improvements, is that there's a deemed supply by the lessee at null value. That's the implication that we're looking at. And think about it. If you've actually paid me null, we circle back. Remember, one of the requirements of the scope was that for no consideration, you paid me nothing as a lessor. Therefore, I told you that on day one, when I build anything on your land, that's attached to your legal title. Immediately, I've given you something. I've given you this improvement. But the VAT Act says it's deemed to be supplied. I've actually sold it to you, but it's at null value, meaning I don't have to pay any output tax. And that's logical, because in this case, you didn't pay me anything to effect the improvement, so I got nothing in return. What this then does, it gives me as a lessee the ability to claim an input tax deduction because I've used it for taxable supply and I've actually supplied it, even though the act deemed it to be at null value. So I didn't have to pay any output tax on the supply of the leasehold improvement. But because it's deemed to be supplied, I can now unblock and I can claim my input tax deductions, because when I effect that improvement, I would probably have enacted or engaged with VAT vendors in the market space, and they would have charged me to effect that leasehold improvement. They would have charged me VAT. So now I can actually claim the input tax accordingly. So let's have a look at this example, because we now just dealt with the scope and the implication of a lessee in the hands of the lessee, where there is a leasehold improvement undertaken for no consideration, meaning you paid me nothing. I want to take this one example, and then we want to look at different permutations so that we can stick through the facts of the example all the time, but we look at different permutations. So let's start off with the first example. We got a lessee. He's going to effect improvements of 1,150,000, and let's assume that the VAT rate is still 15% for the sake of ease at this particular juncture. And the lessor, obviously, what happens to him? He gets the property or the improvement put up on his land, and we know that on day one, this is actually technically supplied, because 20 years later, I pack my bags and I take my bag only, but I leave the property. So immediately on day one, there's a deemed supply that have taken place, and it's going to actually be a null consideration because I received nothing in terms of putting up that property. The implication then is going to be, the possible implications is, firstly, one needs to consider how did the lessee use the asset. If the lessee used, let's assume in example 1 over here, that the lessee used this asset 100% for taxable supplies. In that case, what's going to happen is that we're going to have a deemed supply at null value. Now, because we have supplied it and we paid 100% of that, but the VAT Act told us to pay null. The fact of the matter is that we still had applied a rate of 100% VAT on the transaction of null, which is then null. So on the sale, we've paid 100% VAT, and we've just followed the rules of the VAT Act. But because we actually supplied it and we paid our dues on the VAT sale, which happens to be at null value, what it then does is it allows us as a lessee the ability to claim an input tax deduction of the building and putting up the building when we actually put the building up and we engage with VAT vendors and we pay them VAT, and we can then unblock that 150,000 in our hands. The second possibility, example 2, is now what happens with the lessee is they use this asset for mixed use. So let's assume that they're using it for most commercial letting, maybe commercial on the bottom, and residential letting there on the top. So it's a mixed supply use asset that they're using it for. In that case, again, we're going to have a deemed supply of null for null consideration. And remember what you can do, because this is a mixed use asset, initially, you can only claim a portion of the input because you only use it for 60% taxable supplies. You are therefore only allowed a portion, 60% of the input. But because the VAT Act deemed us to have sold it at null value, remember, we paid VAT on 100% of the sale price, but at null, and the VAT Act told us to do so, we can therefore claim a 16.3H input tax correction of the unblocking of the remainder 40% at this point. So I think now you can see how important it is that I had to belabor the point and show you the principle of a 16.3H input tax correction, where we basically have mixed use assets subsequently supplied, which is the case in this scenario where we've actually supplied the asset. We paid our dues at null on 100% of the selling price, but because we were only entitled from the logics of the VAT Act, it only allows us a 60% input. But because the whole good or the whole improvement in this case was actually supplied, we can unblock that remainder 40%, and in doing so, we are therefore entitled to the whole 150,000, even where the lessee uses that asset for mixed use asset or mixed use purposes. So that was the reason that I had to go through all those VAT adjustments for you, to just show you what is then the implication of the, just to understand that it basically, or understand the mechanics of the principle of a mixed use asset, which was subsequently then sold. Let's look at the last example in terms of the lessee. We're still sticking to the lessee. Let's assume now that the lessee uses this only for letting of residential accommodation, which is an exempt non-supply. In that case, no ever output, no ever input, nothing basically happens in the hands of the lessee. You're not even in the VAT system at this stage. You're only making exempt supplies. You don't have to bother about VAT at all. You can't claim anything. You can't actually pay anything in that particular scenario. Let's then have a look and now circle to section 18 capital C. Now remember the sections that I showed you. Now suddenly we jump to the hands of the lessor, the VAT implications in the hands of the lessor, and now suddenly we migrate all the way to section 18 capital C. I don't know how you're supposed to know that, but suddenly we see that the implications in the hands of the lessor, unlike the lessee, which was in section 10 and section 8, now suddenly we must know that we need to go to section 18 capital C for the implications in the hands of the lessor. And unless, like I say, you're a VAT expert or specialist, I'm not sure how you're supposed to pick that up because it's not even anywhere stated in the actual index of the VAT Act. So let's look at what does Section 18C says. Section 18C deals with the VAT implication of a leasehold improvement where a lessee undertakes a leasehold improvement in the hands of the lessor. But so it says there's a possible deemed output tax adjustment to the extent where that asset has been used for exempt or non-taxable supplies, or the extent for which an input tax is denied. So generally, if that asset has been used for a denied purpose by the lessee or for exempt or non-taxable usage, then what it's saying is be careful because there's going to be a possible, listen to this, output tax adjustment in the hands of the lessor. And that I don't think you would have figured out without having some guidance in the VAT Act. The time of supply is going to be when they complete the leasehold improvement, and the lease improvement is going to be calculated on a special formula, which is A times B times C. Again, A is the tax fraction, times B is going to be the actual value of the completion, and C is going to be the non-taxable usage of the asset. So here we're going to look at the open market value if the lease agreement doesn't specify the value. Otherwise, we will look at the lease improvement value in the agreement that has been actually specified, or we'll look at the actual costs of improvement. And if we can't establish that, we will then look at the open market value of the improvement. And this adjustment is going to take place, guys, in the hands of the lessor, not the lessee. So let's go back to that same example that we were working on. Remember, the lessee undertook leasehold improvements of 1,150,000 in the hands of the lessor, and he received nothing in return. And there was three possible scenarios. Scenario one is he used this for 100% taxable supplies, and we went through the permutation in the hands of the lessee. In that case, he was entitled to the full input tax deduction of 150, and he was deemed to have supplied this at null value. Now, if that takes place, then the implication in the hands of the lessor under section 18 capital C is nothing, because there's no adjustment in the hands of the lessor because it's not used for mixed use. We only have this adjustment coming through if this asset is used for mixed purposes. In this case, the lessee used it for 100% taxable supplies. Therefore, the lessor is also deemed to use it for 100% taxable supplies, and there will be no output tax adjustment. However, in our example 2, we remember that our lessee was only entitled to 60% input. He was deemed to supply it at null. He claimed the actual input of 60%, and he got a deemed 16.3H input tax correction of 40%, therefore entitling him to the full 150,000 deduction as input. Now, if we look at what happens in the hands of the lessor, remember, in the hands of the lessor, if he uses it for mixed supplies, non-taxable usage, that 40% non-taxable usage is non-taxable usage. What is going to happen? There's going to be a deemed output tax adjustment in his hand, and we're going to use that formula A times B times C. A is tax fraction, B is the value of the improvement, right, which is in terms of the actual cost that we undertook the improvement, and C is going to be the non-taxable usage. And if we now look at the entire picture as it's coming together, we can see how the beauty of it and the beauty of the VAT Act coming into sync and into balance, where we see that the lessee was allowed the 60,000 input. This is the very same input output tax adjustment that the lessor is going to have to make. Because remember what I told you in the end of the day, the big picture is that with leases is that who owns this asset? The asset is owned, the improvement on day one. There was a deemed disposal actually from the lessee to the lessor, because remember 20 years as a lessee, you pack your bags and you don't take the building with you, you're actually leaving it there behind. And therefore, if there is going to be any sort of adjustment of that implication, it has to be in the hands of the lessor. And what we are typically doing here is we are seeing that the lessor is actually taking this asset which was used 100% for taxable supplies and now is using 40% for non-taxable usage. And remember, it's a Section 18(1) adjustment that I taught you or I looked at for you. Remember when we left the business, the enterprise, other than through normal sale of goods and service, there was a Section 18(1) output tax adjustment in Section 18(1). Here we see again that special principle or the same principle coming through to say, hang on, if you actually leave in the business, the enterprise division, other than to normal sale of goods or services, you start using things for non-taxable usage, there's going to have to be what we call an output tax adjustment that comes through. And we see everything is back into sync and balance, because ultimately what has happened between the lessee and lessor here, the lessee got a full 150 adjustment. And remember what has happened? I had to actually then declare output tax adjustment of 60,000. One day when the lessor now sells this asset, what's going to happen? He's going to pay 15% VAT on the sale of that improvement. But remember, he only claimed he only got an input tax deduction of 60%. Remember, somebody got an input tax deduction only of 60%. And therefore, subsequently, one day when we actually have that sale of the asset, he's going to have to declare or claim an input tax correction under 16(3)(h) of this differential again of 60%. Because he has paid this 40% as an output tax adjustment, we're going to again see that on the sale of the asset, it's going to be rectified in terms of its VAT balance, and we'll come back into sync one day when we actually have the lessor sell this good onward. So this is like I said, it's quite tricky, but hopefully I've explained it to you in a simple manner. The third example is very simple. The guy, the lessee, in this case, remember, was not in the VAT system. He was leasing it for residential purposes. So in this case, there's nothing. He's not even a VAT vendor. There can be no VAT implications for in terms of the deemed supply, no input tax. There's not going to be any output tax adjustment, because if we're leasing this for residential purposes and we actually do that, then there's not going to be basically any VAT implications for anybody, because we're outside of the VAT net in this particular regard. So what we've basically done now is we've actually just done the VAT implications of a leasehold improvement in the hands of the lessor as well as in the hands of the lessee. And I'm seeing that it's exactly spot on now. It's actually 2:30 exactly. So I think we due for Danny. I'm just checking, Stan. We can take a 10-minute break, and then we can be back exactly promptly at 14:40, please.
Yeah, perfect. Good time for a
Happy.
break.
Okay, thanks, guys. See you now. So 14:40 we'll be back and we'll resume. Okay, welcome back, guys. Maybe what we should do. I just want to check in, Danny, Stan. There's any questions, on the portal that has come to that before we continue from the break, if we can deal with that. If there's no questions, then I'll continue. But just big picture again, just to talk about what have we dealt with in the first section. Let's do a quick recap, and then we can basically go into this last session, which is about another hour, 20 minutes. So what we've discussed until this particular juncture is that we've been dealing with the leasing or the tax implications of leases, particularly difficult concept, as you can see, as depending on the nature of the transaction. The tax implications become quite complex and quite messy as well. The first one that we dealt with, which was the easy one, which is an operating lease, we looked at the VAT and the income tax implications of that. We then had a look at the lease premium, something paid in addition to rental income. What is the VAT and income tax implications, both in the hands of the lessor as well as in the hands of the lessee? And then finally, what we dealt with is we started looking at this concept of leasehold improvements. And before we could actually deal with the leasehold improvements, I had to first of all introduce the concept of VAT adjustments to you. And the reason for that was quite simply because the whole concept of VAT implications for leasehold improvements is interconnected and interrelated with VAT adjustments. So therefore, I had to actually cover the principles of adjustments before dealing with the actual VAT implications of leasehold improvements. So we just ended the last session with the VAT implications of leasehold improvements. We're still busy with that. When we're going to pick it up now, and what we're going to deal with is then the income tax implications for the lessee and the lessor, where lessee undertakes leasehold improvements on land of the lessor. So let's have a look. Let's first deal with the lessee. And now, very importantly, again, big picture, if we just sit back and think about it, what has happened here is that the lessee has undertaken some kind of huge, massive improvement. It's a capital expenditure, definitely, undoubtedly, we can't argue with that. This is capital spent by the lessee on the land of the lessor. So if there's capital expenditure, 11A tells us quite simplistically that you can't get any deduction for capital, any items of a capital nature. However, like I told you always, is that it doesn't all end there. One needs to then migrate and look for specific tax deductions, capital allowances that may be allowed in terms of the Act. And here we see that what comes through is Section 11G, which says that if the lessee undertakes obligatory leasehold expenditure on land of the lessor, then that capital expenditure of improvements that he has effected, one can get a deduction under Section 11 small G of the Income Tax Act. And one needs to also consider another section is Section 13. 13 deals with manufactured buildings, manufacturing building allowances or capital allowances for manufacturing buildings. And we're going to see that because of the interaction between 11G, where a lessee undertakes leasehold improvements and overspends. So it's not obligatory spend, but or contracted spend in terms of the lease agreement. That excess spend could potentially be the lessee can get a deduction for that excess spend under Section 13 if it happens to be a factory or a manufacturing building. And that's purely because of the wide wording we'll see in Section 13. So let's start off with the scope and implications of Section 11G. But before that, let's first deal with the VAT implications. Guys, we just dealt with the VAT implications in the end of the last lecture, where a lessee undertakes leasehold improvements on land of the lessor. That was the whole discussion of the examples that we took through, and we went through the VAT implications already. Now we're dealing with the income tax implications in the hands of the lessee, where there's a leasehold improvement that has been effected to the land of the lessor. We said it's a capital expenditure. 11A generally doesn't allow it. However, 11G is the most specific deduction capital allowance that one needs to consider. And in this case, what 11G tells us is that if it is obligatory improvement contracted for in terms of the lease agreement, then what is going to happen is that the lessor is going to be taxed on that amount, and it actually tells us that provided that the lessor has been taxed on this amount, and we'll deal with the lessor in a minute. We'll circle away from the lessee and look at the lessor in a minute. But it says if the lessor is going to be taxed, then the lessee can claim a deduction over the lease period from the date of completion, and the maximum denominator, the spread that we're going to spread the deduction over in terms of the improvement costs that we spent, is over a maximum of 25 years. So generally, we'll divide it by the denominator. Normal leases in practice that I've seen is always about 20 years. If we're looking at long-term leases of buildings, it could be 5 years as well. 5 years leases are shorter-term leases, but generally the maximum your denominator is going to be is then 25 years. So we're spreading it over the term of the lease, and we're going to start claiming it. Very importantly, we see from the date of completion. Now, something that the Act is not very clear about here is it doesn't talk about brought into use. So there could be a disconnect between the date of completion of the improvement versus the date it actually is brought into use. My personal view is, and it is a view that I hold, is that generally all allowances sections you only start claiming the deduction on capital allowances of all your deduction sections only when you bring it into use. Even though the section here is silent, I still think that you should only start claiming the deduction once it's completed, but subsequently only once it is brought into use. We don't see that wording coming to the specifically in 11G, but my view is that wait till it is actually brought into use to begin claiming the deduction and spreading it over the term of the lease. Some issues that come up is what happens if you have an excess spend. So you spend more than obligatory improvement. I told you the only way you can get that excess spend as a deduction is, for example, if you have effected improvement to a manufacturing building. So it has to be a Section 13 allowance, and that's purely because of the wide reading of that section that it actually allows you, and it actually connects you back to Section 11G. It will actually tell you that you can get the excess spend in relation to a factory building if you have to overspend. So a couple of years, a very interesting example that we looked at is, for example, all your McDonald's drive-thrus, I think, are actually built, the actual drive-thrus itself are built on land of the lessor. These are exactly leasehold improvements. And obviously, if they have only obligated a certain spend, they can only get a certain amount of the deduction that's contracted for under 11G. But if they overspend and they actually start doing improvements beyond what was, beyond what the legal contract said, that excess spend can only be deductible under Section 13. And remember, in order to get that deduction, you need a process of manufacture. So it has to be sort of a manufacturing building. But from court cases, some court cases have said that the production of burgers, for example, could be considered a process of manufacture. So, there is always arguments to actually say that even the excess spend can be deductible under Section 13. So that was a very interesting case, practical scenario that we had to look at one particular point in time in relation to leasehold improvements. Then what about the value? So what would happen if you increase the value, right? Because we said that 11G only gives you the deduction that is contracted for in the lease agreement. So it's very important that the lease agreement specifies that value. Otherwise, you're not going to be able to claim the deduction as a lessee. So if that value changes, provided that the lease agreement has been updated before the completion of the lease improvement, you can still get that increased value. So it's very important that from a legal point of view, that when you look at these deductions as well, that you make sure that that legal agreement is tight and that increased value has been signed off before the completion of the project. If you have done that, you'll be able to claim that deduction then accordingly. Then renewal periods, indefinite lease terms. We dealt with this also when I covered lease premiums. I told you that if this happens, take into account a reasonable period that the commissioner will agree to. Don't make it excessive. Rather work with something that it is. The SARS Commission, you can also approach SARS in this regard to ask them what would be considered as a reasonable period to write off the deduction off against, and rather go on with something that they would actually consider to be reasonable. Then again, early termination. Remember, when I dealt with the lease premium, I told you if you stop using the asset, you're going to stop claiming the allowance. Now, unlike a lease premium, we see something very different here coming into being. And I'll give you the logics behind why I think it's different as well. Because I always like to think about why the Act does certain things and take different stances in certain regard versus different other sections. So when we dealt with 11F, the lease premium, I told you when you stop using the asset, because you no longer bringing the asset into use, you cannot claim that deduction. No more, you lose out the balance of that lease premium. So you cannot, if there's an early termination of the contract, you're going to lose out the premium over because you're spreading it over the term of the contract. But if we early terminate and we claiming a leasehold improvement under 11G, that outstanding spend can be claimed in that year before of termination. So very importantly, the reason for that is quite simple. If we circle back, remember I told you that the leasehold improvement under 11G didn't ask us to, the requirement was that we completed the asset. Nowhere did we actually say that in order to get a deduction, we need to start using the asset. Therefore, if we stop using the asset, we can still get the balance of the deduction. And the reason I think it is built in this way is that, remember, like I told you, as a lessee 20 years later, you pack up, you leave the building, and you only take your bags and you go. It becomes the asset of the lessor. And therefore, even from a VAT point of view, we've seen that if any output tax adjustment was going to transpire, it was in the hands of the lessor, not in the hands of the lessee. That anything that happens is going to be, it's his asset. So if any tax implications is going to arise, it's going to be in the hands of the lessor. And what we're trying to do here is, because you've actually spent this, it's a capital expenditure. They want to actually give you the full deduction. So if you early terminate, walk away from the lease, or so you can claim the balance of the 11G that you did not claim in terms of the spreading that you're still entitled to. So very interesting. We see a different position being taken here versus the lease premium. Again, I think it's logical if I sit and think about it. We don't see this early termination that I'm dealing with here in this slide come through in the Act itself. Where you'll find this again is in the deep interpretation note on section 11G. SARS has got a 50-pager on section 11G alone on this issue, where they basically go through the tax implications, and this is where they give their view on the early termination. So some practical issues that we have dealt with, I think it's important as well. We're still busy, remember, in the hands of the lessor, or rather than in the hands of the lessee. We now want to change our focus of taxpayer, because we said that the lessee is going to get a 11G deduction if he undertakes compulsory contractual obligated spend in terms of the lease agreement, and any excess spend he will be able to possibly get it only if it happens to be on a manufacturing building under Section 13. That was the implication in the lessee. Let's now then spin to change taxpayer focus and look at the hands of the lessor. What is going to happen in the hands of the lessor? Well, quite simply, what's going to happen in the hands of the lessor, we see first of all, we're going to have a lease improvement specifically caught into the gross income definition under paragraph H. So the first important point, or what we've seen, is that we undoubtedly, we had this conversation already, that if we have a leasehold improvement undertaken in the hands of the lessee, on the land of the lessor, that's capital expenditure. We're not even arguing that. It's definitely capital expenditure. If we look at gross income definition from the perspective of the lessor, that's a capital inclusion, and the inclusion of a capital nature. So gross income says you cannot include anything that's in capital in nature unless it is specifically included under the gross income subparagraphs. And when we read paragraph H, we find a specific inclusion and catch for leasehold improvements. And it tells us, despite the fact that this may be a capital receipt, you're going to pay income tax on it. So we're going to include this number, the value of the whole improvement, we're going to basically include into our gross income. However, immediately we see what happens is that because we have an inclusion under gross income paragraph H, we are then entitled to possible capital allowance of a lease premium. We already covered the lease premium under section 11H, or a lease improvement. So both lease premiums and improvements are caught as a deduction under 11H, and we've already circled in on the lease premium and the deductibility under 11H. Now we're looking at the lease improvement that one can get under 11H. And here we see, when I talked to you earlier about when I dealt with the lease improvement, what the deduction is about under section 11H, if we go to the detail, is that it is a present value of the future cash flows that you're going to claim as a deduction under 11H. So the deduction here will not automatically always match the actual specific inclusion, but rather it will be the present value of the future cash flows that one claims as a deduction, and that is the number that you're going to claim in as a deduction under 11H. So if we basically then circle in on the lessor, remember we said there's going to be an inclusion under gross income paragraph 8, a deduction under section 11H. And remember, 11H does not apply. We went through this in the context of a lease premium. I'm not going to belabor the point again, but again, be careful when it does not apply, because automatically in your case, what you want to see is obviously you're going to be seen in your tax computation for your clients. You're going to obviously see an inclusion of the whole leasehold improvement. It's a big number. It's a capital expenditure that the lessee expended on your land, on your lessor's land. That big number is going to come into the tax comp, and SARS is going to look at it, and they're going to want this here, and they want to see this in your gross income definition or your calculation of your tax computation as an inclusion, despite the fact that it is capital in nature. You are allowed the deduction under 11H, but be careful, because if 11H does not apply in these three instances where I've told you about, where there's some kind of connection or connected parties, the possibility is that 11H won't apply. And if that is the case, think about it. What is happening in reality is that you've got a capital receipt being taxed under income tax at 27%. So not even as a capital gain, and a capital gain to the capital gains tax system, which you know the effective rates are much lower than income tax, which is 27%, but rather you're going to be paying, or your client is going to be paying 27% on the whole improvement that has been undertaken on land of the lessor. You can think about, for example, the example I gave you with McDonald's drive-throughs, all those lease improvements or the buildings itself that has been placed on McDonald's land. I mean, if they can't get this deduction, it's going to be a big problem for them, because they're going to have a big inclusion times 27% immediately on that number. So it could be quite horrific if you have some kind of avoidance arrangements that are going through. So you want to obviously make sure that you are entitled to that input under 11H. So what we've dealt with now, we looked at specifically before the break, we started with the implications, VAT implications of a leasehold improvement, particularly complex, like we said, quite messy. Sections are all over the VAT Act, but we navigated through it, and we've seen the principle ultimately is start with the inquiry in the hands of the lessee, move to the lessor, and look at the potential output tax adjustment in the hands of the lessor. We then looked at the implication, the income tax implication for the lessee, and we said, hang on, despite the fact that it's capital in nature and it's a capital expenditure, we can get 11G special allowance if it's obligatory spend. If we excess spend over and above the contract, look at section 13. If it's a manufacturing building, you're potentially going to be able to get that excess spend allowance, a capital allowance under section 13, and you'll claim it accordingly. Then we basically looked at the lessee. We focused on the lessee from his perspective, and we said, hang on, that's a specific inclusion into gross income under paragraph H, and we entitled to a specific capital allowance under section 11 small h, but provided that we beat the anti-avoidance and we don't fall foul of the anti-avoidance provisions that come through. Now, finally, to close out this leasehold improvement discussion, we still then need to deal with the capital gains tax implication. So the long and the short of the capital gains tax implication is that actually nothing happens until the end of the contract, right? But it's more complex than that there. I'm basically giving you the short version of the long technical discussion, but I'll take you to some of the thought process. Because remember what I told you, all these discussions that I've been having with you, they go back to that principle that I told you that technically we have separated the asset into two parts, the bare dominium and the right of use, which is the use of right? So when you enter into lease, technically you've actually split the asset into two. The owner has the bare dominium, which is the ownership of the asset. And what he technically does is he sells his right of use, which he has, to you as a lessee. And he says, you pay me rental in return for the right of use, and you can use my asset. So I'm splitting the asset into two, and I'm giving you that right of use so that you can then use that asset. Now, from a capital gains tax point of view, if we go back to that fundamental principle or legal stance that I've actually explained you, what has technically happened on day one when the lessee undertakes leasehold improvements on land of the lessor? Remember what I told you, who owns the asset? The asset is owned by the lessor, not the lessee. Anything that you're going to attach to the land of the lessor is not your asset. You don't have the legal title to that in the end of the day. Like I told you, 20 years later or 5 years later, your lease comes to an end. You take your bags, you pack up, you leave the improvement, and you walk out the building. You can't take the building with you. You only had the right of the use. So technically, for capital gains tax purposes, there is a deemed disposal on day one, a part disposal of the asset by the lessor, because what has happened by the lessee, because the lessee built this asset on land of the lessor. On day one, what has he got? He only retains right of use, but on day one, he's lost right of ownership, because ownership attaches to the land that is built on, and that is in the hands of the lessor. So immediately on day one, what we see is that there's a part disposal happening for CGT purposes. Now, if we go, it becomes very complex, like I say, and we then go into paragraph 33(3)(c), which then deals with part disposals. It then tells us, hang on, if there's a lease improvement and there's a part disposal, don't do anything. Don't do the CGT computations. Wait till the end of the lease, because the actual disposal, the time of disposal must be postponed, and the implications, the capital gains tax implications, must be postponed till we come to the end of the lease. At the end of the lease, if you then think about what is the tax implication, so let's do the tax implication. So we're going to do nothing when we actually just improve the building, even though there's a part disposal by the lessee to the lessor. He retains the right of use, but he actually loses ownership on day one because he went and built on somebody else's building. So because of the part disposal, we know it feels like there's two parts happening here. Something has been given away. I should be paying maybe even CGT on it. It says, don't worry. Don't do any calculation. Wait till the end of the term of the lease, and then we'll close it out. You can then do the capital gains tax calculations at that point. Now, at the end of this lease arrangement, let's run through the capital gains tax implications that would transpire at the end of the lease term. Remember, in the hands of the lessee, what had happened? The lessee was entitled to a Section 11G deduction, even though it's capital in nature. Remember, we undisputed that this is a lease improvement we are dealing with. It's a capital expenditure that you've incurred. Despite that, the income tax system gave you a Section 11 small g deduction. So you claim the deduction under 11G spread over the term of the lease with the maximum of 25 as a denominator. And from the date of completion, you claimed it. And even if you stopped using, you early terminated. I told you just when we did the discussion on 11G that the balance you will be entitled to in that year of early termination, you claim everything. So the long and the short is that you've got a deduction of the full spend of the lease improvement under income tax. So therefore, if you then at the end of the term calculate, if we now going to really calculate what is the base cost of the asset for the lessee, is what he spent. But base cost is what you spend minus any past deductions or allowances through income tax. You got the whole amount as 11G deduction. So your base cost is actually zero. And your proceeds, if the seller didn't pay you anything to effect the improvement, is zero. And therefore, at the end of the term of the lease, actually, if we run all the numbers and we postpone our capital gains tax implication till the end of the lease in the hands of the lessee, it comes down to null effect. So that was the long and the short. Remember, when I started off this, I said there's actually no implications in the leasehold improvement until the lease contract comes to an end. That's a technical discussion of a long discussion that comes down to the fact that in essence there is actually no CGT implication on the leasehold improvement, unless obviously you did get some kind of a payment towards you to effect that leasehold improvement, where in that case you're going to have proceeds that you're going to have to pay CGT on at the end of the term of the lease. But generally, the long and the short is, if you run all the technical arguments and you go through the whole process of a very technical discussion, it should come down to almost nothing. That is basically what we've dealt with until now. So we've covered the operating lease. Let's just circle in big picture again. We've dealt with the lease premium, the tax implications of a lease premium. We've also dealt with the leasehold improvements, a particularly complex area from the three that I've dealt with. Most certainly the most difficult one, I think, when you see leasehold improvements, be very careful from a tax planning or advisory point of view, or when you're dealing with the tax implications of your client base. Be very, very careful when you see leasehold improvements. As I've navigated this with you this afternoon, you can see the complexity that is involved in leasehold improvements. Then the last two issues that I probably want to deal with you is, and I'll make some comments on the suspensive sale agreement, which is not really a leasing arrangement, but rather to then now discuss a little bit about the recoupment in the hands of the lessee. We're going to go through that. So I want you to change your focus or big picture in terms of what we're going to deal with now over the next 20 minutes or so. We're going to look at the recoupment. And then lastly, what we're going to do is we're going to try and close out with the concept of finance leases and what is finance leases. So big picture again, let's think about the principle of a recoupment, the tax principle of a recoupment. If the lessee was entitled to past deductions and allowances, just know this. This is how you pick up in practice as well, whether there's a possible recoupment, because if there's going to be a recoupment and you don't know about it, remember, and if SARS picks this up on audit, then your client is in problem, because there's going to be penalties and interest. And like I told you, they're going to go 5 years back. So it's important to at least have enough knowledge to be able to pick up that there's a possible recoupment going on. So the first instance or the principle I want to tell you with or leave you with is that when we're dealing with leases, there are certain deductions or allowances that we've dealt with this afternoon that the lessee is entitled to. Now, if the lessee at the end of that term, or if he early terminates, so it doesn't have to come to the end of the contract, he can even early terminate. We dealt with that early termination clauses and the tax implications where they early terminate as well. In case of a lease premium, in the case of a lease improvement as well. But we know very well that the lessee, even though there is capital expenditure happening, they are entitled to income tax deductions that we've discussed this afternoon. Even on the rental income that the lessee pays, he gets a deduction under 11A, the normal operating lease that we started off with. Now, at the end of the term of the lease, if that lessee has the right to buy the asset or to continue, there's two options. Either he has a right to buy the asset, or he has a right to continue leasing the asset for a very low rental. Then we are going to have a lease recoupment in whose hands? In the hands of the lessee. Why? Because he was entitled to the past deductions or allowances. So very important, the trigger or the way you pick up the possibility in practice that there's possible recoupment going to happen in the hands of the lessee is when you see this concept of either when you early terminate the lease or the lease comes to the end of its term, and the lessee holds the right to buy the asset or to continue renting it out for low rental. Be very, very careful that we have not triggered the recoupment provisions for the lessee under Section 8.5, which I'm going to now deal with. So when we looked at remember when we dealt with leases, we dealt with income tax implications for the lessee as well as the lessor as well. And if we basically just go big picture now, because we've dealt with this in the past, the first part of the lecture, when we looked at the income tax implications in the hands of the lessee, we know that the lessee is going to pay rentals in the operating lease. He's entitled to Section 11A deduction ex VAT. The leasehold improvement or premium that he pays in addition to rent is a capital expenditure, but Section 11 small f gives him the deduction under 11F for capital expenditure for lease premiums paid. We also dealt with the VAT implication. We said there's VAT on there as well. Even though it's a lease premium, it's going to have output tax implications, and it's also going to have input tax implications accordingly. Then if we basically looked at the leasehold improvement, the income tax implications in the hands of the lessee, remember is that the lessee was entitled to Section 11G allowance on the obligated spend. But if he spent over and above the contracted amount, then any excess spend that he made, if it's a manufacturing building, you'll consider Section 13. If it's the other kind of an improvement, he can't get a deduction on that excess spend because 11G only deals with obligatory spend in terms of the contract. Now, very importantly, the principle now comes through is that can you see that the lessee was entitled to past deductions or allowances in leasing this asset? And at the end of this asset and end of this lease, if he has the ability to buy that asset or to continue renting it at a low rental income, then we're going to have a possible Section 8.5 recoupment triggered in the hands of the lessee. So it doesn't really matter whether this is a finance lease or it's an operating lease. Nowhere does it tell us that, you know what, this needs to be a finance lease or an operating lease or you needed to have paid interest. It really doesn't matter. It applies to all leasing arrangements. Wherever you've got this past deductions or allowances that have come through, you're going to be very careful that at the end of the term that you don't have a trigger of Section 8.5, which is a special recoupment provision, like I say, the ones that you guys know that you were taught, remember when you back in varsity days as well, is a normal sale of an asset. And the one that you guys do commonly is that you have that right back of the past allowances when you trigger a sale of an asset, and you do CGT as well, obviously. So let's have a look. We're going to now then deal with the implications, or we're going to now unpack what Section 8.5 is all about. And like I say, big picture, Section 8.5 deals with the recoupment in the hands of the lessee. The implication is that we're going to have a lease recoupment in the hands of the lessee. Now, there's two possibilities with Section 8.5. The first possibility, I told you the trigger is either that I have acquired, me the lessee, I've acquired this asset at the end of the term, or early terminated the clause and I basically acquired the asset, or I have not acquired the asset, but I continue to release it at a very low rental. Those are my two trigger points to pick up whether there's going to be a possible lease or recoupment in my hand. So big picture again, either I acquired it or I did not acquire it, but I continue to lease it at a very low rental. Then I need to be careful that in the hands of the lessee, there isn't a recoupment. Now, if we have acquired the asset, there's two sections that then come into play. The first is Section 8.5A, and the second section is Section 8.5B. Now, what Section 8.5A is about is it's an anti-avoidance section, and what it tries to do is to say, hang on, when it comes to leasing arrangement, there's lots of anti-avoidance or tax planning that goes around leasing as well, sale and leaseback arrangements. I haven't even covered that today, but there's a lots of anti-avoidance provisions that try to target leasing arrangement because you can move things around between the lessee and lessor. So there's targeted abuse, and one of the sections here that comes to play is Section 8.5A in terms of a recoupment by the lessee or in the hands of the lessee. And basically what abuse it tries to target. I'll give you the scheme, and then you'll understand the implication. So what abuse it's trying to target is that if we think about a lessee, and a lessee is entitled generally to income tax deductions under 11A in terms of leasing the asset itself. So the scheme is generally what they're trying to do is to say, hang on, so if you're going to buy this asset at the end for me in any event from the lessor, what we can do is we can inflate the rentals, make it very high during the course, so you get nice fat deductions, and then I obviously, maybe I have to pay more income tax on that, but you know what, maybe I'm in a assessed loss position anyway, so I don't mind sucking up that additional income in my hands. And you obviously got lots of you got lots of income that you're making, so you can get nice deductions. So we overinflate the rentals, and that is going to compensate for a reduced purchase price in the end of the term. Because remember, what we are talking about here is that you as a lessee is going to have the right to basically buy this asset at the end of the term of the leasing arrangement. So the whole complex, the whole scheme that Section 8.5 is trying to attack is this sort of scheme where you overinflate the rentals during the course of the lease term arrangement. And what that lease term, what it then does is it basically ensures that at the end of the lease, because I've overcharged you in terms of monthly rentals, at the end of the term, I will undercharge you for the actual acquisition of the asset. And if that is the case, so I haven't seen a lot of this 8.5As in practice. The 8.5B is more relevant, if you want to call it, but just an awareness, and be careful about the 8.5A as well. It's a targeted abuse against this kind of scheme of arrangement. And it basically says that if that happens, then the recoupment is going to be equal to the rentals that were used to reduce the purchase price of the asset. So the lessee is going to have a recoupment equal to the overcharged rentals, which were not market related. That's what they're going to try and attack the scheme in terms of, if you have a SARS auditor, that's what they're going to, if they have to apply Section 8.5.8 to you, they're going to basically try to say, okay, what's the market related rentals? You were actually overpaying market related rentals in relation to the market, and those were actually applied to reduce your purchase price at the end. They're going to argue that, and therefore what they're going to then do is they're going to then trigger recoupment in the hands of the lessee, and they're going to adjust, and they're going to compare market related rental to what was actually deducted, and that differential is going to be seen as a monthly recoupment, or it's going to be added up over the term of the lease, and they're going to trigger recoupment in the hands of the lessee. So that's one that, just one kind of a abuse that Section 8.5.8 tries to target in terms of leasing arrangements. Like I said, I haven't covered all the abuse. So if you're thinking about schemes as well, please stop thinking of those schemes. There's lots of Section 23 capital A also deals with leasing arrangements where there's specific a specific targeted abuse. So if you're thinking of an abuse with leasing, please stop that thinking immediately. There's possibly a section that is already, somebody has thought of that abuse, and it's already the tax act has already plugged that to loopholes. I can assure you of that. Because there are many targeted sections to attack abuse in terms of leasing arrangements. So let's then have a look at 8.5B, which is the common one in practice. This is the one that you probably, either you miss or you will see in practice, but it's very common at the end of the term of the lease that you are entitled to buy that asset. Now, this could happen, and it happens generally in finance leasing arrangements. You have the option to either buy the asset at the end of the term or not. You can walk away, but one of the concept of finance leasing is that you're given this option. So if you have the option to buy the asset, whether it's an operating lease or finance lease, it doesn't matter, and the purchase price is less than the market value at the date when you buy the asset as a lessee, then in that case, what is going to happen is that we're going to trigger a recoupment of the difference between the market price and what price the lessee actually pays to buy the asset. But remember the principle. the principle of any recoupment is that the recoupment can never exceed the past deductions or allowances. So if it's a finance lease or if it was an operating lease, you will calculate all the deductions that you are entitled to under the term of the lease. And then you'll compare to this recoupment calculation that we've done. And remember, this recoupment calculation is limited to those past deductions and can never exceed that. So it will always be limited. There's a limitation rule or number that we have to basically calculate and compare it back to. So this is the one I think that, in practice, I think, I've also spoken to Pitt now, and he also told me this is the one that is more commonly seen in practice. The 85A is not so common, but in leasing arrangement, these things actually particularly happen. We even tested this a couple of years ago, the SICA IAC. ITC now knows the SICA IAC. Things are moving all the time. There's no ITC no more. It's an IAC. Initial assessment competence now. A couple of years ago, I know it specifically looked at this abuse and it tested it in because of the prevalence that I think we see on this in the market space. And I think a lot of people are not aware, and that's why I wanted to cover this here with you, so that at least you got an awareness as often you walk away with that you can pick these issues up in practice as well. Very importantly, we are dealing with an asset that the lessee has acquired at the end of the term of the lease. So that means that you, the lessee, have bought this asset at the end of its term. Now the question is, what allowances? Because if you bought the assets, remember, you know the new owner of the asset. You must claim allowances and capital deductions on it. The capital allowances that you can claim on, the interpretation is, and the view out there is that this leasehold recoupment under Section 8.5 that is triggered will form part of the trading stock or base cost of the asset. So it's very important if we look at Section 22 for trading stock, because remember, when you buy this asset as a lessee, you can either hold it as trading stock, revenue asset, or capital asset. It's one of two options. It can't be both of them. It's going to be either trading stock for you. If it's not a revenue asset, it's a capital asset. In that case, you want to claim allowances on it. Now, both Section 22, which deals with trading stock, and paragraph 20 of the 8th schedule, which calculates your base cost in the 8th schedule, they both reference and connect back to Section 8.5, and they say that can be added to your base cost of the asset or to the cost of the asset. So therefore, any recoupment that we've calculated under Section 8.5, A or B, and we've got a recoupment going over there. That recoupment that you pay, because you're going to pay income tax on that now at 27%. That recoupment, not a tax that you pay, the recoupment itself can be added to the cost of the asset because you've just acquired that asset as well. So that's going to be forming part of the base cost. So very importantly, just to take note of that particular connection back from Section 22, and like I say, paragraph 20 of the base costs, in terms of the 8th schedule, and they both circle reference you back to Section 8.5A and B, and they allow you to add that to your costs of the asset going forward. So what we've dealt with on this part of the slide, on the left-hand side over here, is where you've acquired the asset, but now we want to step off that and we want to actually move to the right-hand side of the slide, which deals with the position where you don't acquire the asset at the end of the term of the lease, or remember, it doesn't have to always be at the end. The act in terms of Section 8.5 doesn't talk end of the term of the lease, but it says when the lease is early terminated or comes to an end. So let's assume you now don't buy the asset. But in fact, what you do is that you continue to lease the asset after its lease period. And you don't pay anything. So here's your triggers that come to. Be careful of this. Low balling as well in leasing arrangement. It's quite common in practice. You see these things in leasing arrangement. You don't think of tax implications, but yet there are quite serious tax implications that come through. So either that you have not paid anything, because it's now really funny, because things like that, the moment you don't make a payment or something of this actually happens, we think immediately that, this is not normal. I'm continuing to lease this asset and I don't have to pay anything. What's the tax implications? There's possibly going to be tax implications that are associated with this transaction. Or alternatively, you continue to lease the asset for what we call a low fee, which is what we call a nominal consideration in the Tax Act. So the moment we use this word nominal basically means a very little amount, right? So what is nominal consideration? We're going to have to test that. And if this is the case, we don't actually have any payment. We continue to lease the asset. We didn't buy it, and we don't make payment, or we pay very little payment to continue leasing the asset. There's going to be possibly a recoupment, and the recoupment is going to be at the fair market value of the asset, right? So we're going to have to calculate firstly what is the fair market value of the asset, and we're going to also have to calculate now what is nominal consideration, because we've got two important tax concepts that have now come about, which we need to debrief and we need to go into. So let's talk about that. What is the nominal consideration? How do we calculate this, whether the rent is nominal or whether it's low or not? The Act is very clear in that regard, and it tells us how to calculate what is nominal. It basically says that to calculate nominal rent, low rent means that the current rental that you continue to pay is less than 10% per annum of the fair market value. So all it's saying, a very logical rule, they are saying that, you know what, if you take the fair market value of this asset that you are leasing, 10% is what's the value that you should be paying in rent. If you're paying less than 10%, anything than 10% of the fair market value, I think you're paying a very low rental. And SARS is obviously saying, we're asking questions. It seems a little bit odd. It seems a little bit funny, right? So how do we calculate this fair market value? We're going to take the cost to the lessor, and we're going to less 20% per annum depreciation on the reducing balance method. You guys are expert accountants. You'll know how to do it. And obviously, if you've got a part of the year, we won't reduce it, but we look at completed years. So we've seen this principle come through a couple of times. Obviously, when we also calculate the right of use of a car, for example, in the Tax Act, we see the same thing come, the same principle coming through. To calculate fair market value, take the cost of the asset to the lessor, and we're going to then less it by 20% per year on the reducing balance method of each completed year that the asset was used. Then let's have a look now, because we've just gone through a lot of scope and implication of 85B Kappa A. So let's have a look at the short example to just bring it together to see that you can run the numbers and that you can pick it up in the facts and scenarios if you have to be in practice as well. So we've got a lessee limited lease and asset from a lessor for a period of 24 months. It's a monthly installment of 100 rands up to 31 December of this year. The lessee at the end of the lease then acquires the asset for no consideration on the date, while the asset had a market value of 1,500. Important, guys, this is a section 85B. Remember, we're on the left side of the slide, we're acquiring the asset, and we didn't reduce or overinflate the rentals. It's not the 85A, it's the 85B. The recoupment is going to be what I paid for the asset less the fair market value of the asset. If I paid nil, and the fair market value is 1,500, the recoupment in the hands of the lessee is 1,500. The asset originally costed the lessor 2,000, and both companies have a year end, and the recoupment is going to be calculated. Like I said, this is in essence what we refer to as a section 85B recoupment, and we're going to recoup the difference between the market value and your actual payment. Your payment is nil. The market value is 1,500, therefore the recoupment is going to be 1,500. But remember the principle that I said earlier, the recoupment can never ever exceed the lease payments or deductions that were previously claimed by the lessee. And in this case, they would have actually, they had a 24-month contract until the completion of the lease. So they would have claimed 100 Rand times 24 over 24 months. So they would have actually claimed 2,400 Rand. In this case, there's no limitation because the lease does the recoupment does not exceed that amount. If it exceeded it, we would have actually limited it to the past deductions. No need to limit it, and therefore the recoupment is going to be 1,500. So here's a short example to basically just display, and so that you can pick up this in practice. Like I said, this is the one that Pitt, I think, told me is particularly common in practice as well. The other one that we want to deal with, and just let's look at this example together as well. Lessee limited lease an asset from lessor limited for period of 24 months for monthly installment of 50 rands up to 31 December this year. Lessee Limited retained the right of use of the asset after the end of the lease, but only paid 5 rand. Now, immediately we can see something funny is going on here. It doesn't feel like market-related rent. It dropped from 50 rand to 5 rands. The asset originally costed the lessor 2,000 rands, and both companies have June year ends. What is going to be the implication? We look at the original cost to the lessor when he bought the asset, obviously, and we're going to reduce it by 20% per annum on the reducing balance method for each completed year. And we're going to calculate, in doing so, the fair market value. So obviously this guy bought it at the beginning, and the lessor, and he leased it out for 2 years. Remember, it's a 24-month contract. Therefore, we see depreciation at 20% for year 1, depreciation again on the reducing balance method on year 2, 2 completed years. The fair market value at the end of the term of the lease after 24 months is 1,280 rand. Then we're going to test now what is nominal, what is the fair market price of a rental. And we said 10% of the fair market value we've calculated is considered to be a fair rental for the whole year or per annum. 128 rands is the number we come to. What are we actually paying going forward? We continue to lease this asset at 5 rand, very, very low rental, times 12 months, we're paying 60 rand. Because our rental is less than the fair market or nominal value or nominal fair rental in the market space, we're going to therefore have a recoupment. And the recoupment is going to be calculated on the fair market value of the asset we calculated, which is 1,280. But just remember that the lease recoupment can never exceed the past deductions or allowances that the lessee was entitled to. In this case, it was an operating lease, and the past rentals that the lessee was entitled to was 24-month contract at 50 rand, so 1,200. Therefore, in this case, we're going to limit the lease recoupment to 1,200. They got past deductions of 1,200, and they got a full recoupment of 1,200. In essence, we've taken back, SARS has taken back the past deductions or allowances on this asset to a lease recoupment. So this is also a very, very tricky one. Like I said, we've now covered the leasehold recoupments, but the Section 85B that we just covered now as well, be careful for that one in the market. If you see that we continue to lease this asset out for very low rental, there's possibly a recoupment. If I circle back to the slide, this is the slide we're dealing with. The asset is acquired for no, asset is not acquired, but you continue to lease out that asset. Be careful, because in that case, there could be a recoupment that triggers. Now, very important principle or point, I've put up that bubble over there, or the thought process, is that where you fail or where you do not acquire the asset, it doesn't apply to buildings. And I think the logical reason for that is that no one will allow you as a lessor to continue leasing the asset for no payment or for very low rental. And the reason for that is that, so it doesn't have to apply to buildings, and because logically, if you just think about the lessor, there's no ways the lessor is going to continue leasing that out to you for no payment or very low rental, because what he's then doing is he's creating a problem for himself there, whereby you're going to be there in the building of his, you're not really paying him, or you're paying him very little, and you're happy with that as a lessor. And you know legally what happens with that position is that if you will lose ownership of that building ultimately legally, because if you just allow somebody to continue using for no rental, you're almost passing ownership to the lessee. You're actually happy with that arrangement, and legally, in terms of legal contracts, it says that ultimately, if you do nothing to recover from anything from the lessee, you actually pass in ownership from the lessor to the lessee. So because in practice that will, that is not going to happen, I think the act is then so smart as well that what it does is it doesn't apply to buildings. So it, where the asset is not acquired and it continues to be leases, it only applies to movable assets and not immovable property, because like I say, I don't think any lessor is going to allow this to actually happen. So what we've covered now, just to circle back again, big picture, to bring it all together, we've got about 25 minutes now to go. We're going to cover the last aspect, which is the finance lease. We've basically dealt with the operating lease, the VAT income tax implications till now. The first session, we also unpacked the lease premium. You guys can now deal with the VAT implications of a lease premium, the income tax implications associated with it. We've navigated through the very complex area of leasehold improvements. We looked at the VAT as well as the income tax implications. And then now we came to something, I think, something that I wanted to leave you with this afternoon, and particularly just make sure that you have this awareness that be very careful when you see leasing arrangements and funny things happening at the end of the lease where the lessee has an option to buy it or continue renting it at a low value. Be careful in the hands of the lessee. There's a possible recoupment, and if you're not accounting for that, that has serious tax implications that, SARS will obviously pick up if they come to and do audits on the client. Then finally, what we're going to deal with is we're going to now deal with the finance lease, because a lot of what we've dealt with till now is, we've looked at the operating lease. We haven't really touched this devil of the finance lease and what's associated tax implications. So we're going to deal with this in this final session. So let's have a look at the concept of a finance lease. So how do I know that it's a finance lease? Again, big picture, I always like to step back, big picture, and ask myself, how do I even pick up the transaction? Because we said when we dealt with an operating lease, the differentiator was that there's no finance. The lessor sold you the right of use of the asset in return for monthly rental, and you're paying him for that use of the asset, and he's selling that to you on a monthly basis, and you're paying him a rent. But there was no finance associated to that. You didn't have to pay him interest. So the key differentiator for me is that when I look at a finance lease versus an operating lease, in terms of a normal rental agreement, which you guys see all the time with your clients, how to differentiate these two is with the finance lease, you're particularly going to see this concept of finance or leasing or interest basically coming through. So what is then the VAT implications and then the income tax implication, the associated income tax implications that we want to deal with? So let's deal with it. The first thing we want to identify again, who is the taxpayer that we're dealing with? And the first taxpayer that we're going to deal with is the lessor, right? We start in the hands of the lessor and we ask ourselves, okay, what is the tax VAT implication? Before we even can go into income tax, let's deal and unpack the VAT implications in the hands of the lessor and the lessee, and then we'll deal with the income tax that's associated and followed through accordingly. So the VAT implications, it says that if we're dealing with the lessor, this finance lease, the so-called finance lease, falls into an installment credit agreement definition, part B of the definition. And that simply says that if that falls into the scope of part B, then the implication is going to be that the lessor must declare the full output tax upfront on the cash value. Cash value is a defined term which is inclusive of VAT but exclusive of interest. So we're going to obviously times it by the tax fraction to calculate the value over there. The time of supply is going to be the early of delivery or payment, and the value is going to be driven off the cash value. What about interest? Interest is an exempt supply. We're going to treat with that. We're going to treat the interest as a separate transaction, and associated VAT implication on the interest is going to be nothing because it's an exempt supply. So the long and the short of this is that where we have a finance lease, the implication is that even though the lessor is going to receive monthly return or installment payments on the leasing of that asset over maybe 24 months or 5-year contract, but the implication is SARS is saying, hang on, we don't want you to declare monthly output as you receive this lease installment repayments. We want you on the early of delivery of payment to declare the full output tax upfront. So this is a nice little cash flow for SARS in the hands to make sure that they obviously get the full output upfront. And the timer supplies the early of delivery of payment. Now, very importantly is that the general timer supply rule for VAT purposes, is the earlier of invoice of payment. Now we're substituting it between invoice and we're substituting the time and supply for delivery of payment. There's a reason behind that, why they do that, because the special rule that I've just explained to you, where the lessor has to declare the full output tax upfront, only applies to movable assets. And therefore, with movable assets, guys, I have to deliver it to you. It has to be moved to you. So therefore, we change the time of supply for the earlier of from invoice to delivery of payment. Very importantly, it's also common practice, and you know this, that the chances of a fixed property, non-movable asset, immovable asset being sold on a finance lease is highly likely. It's probable, not even highly likely, it's highly probable it's going to happen, because who can afford to buy fixed property, immovable property cash, right? So there's going to be finance leasing arrangements to that. However, what I'm going through here doesn't apply to fixed property transactions, because the VAT Act has its own special time and value rules for fixed property transactions, which I can cover in another session in future if we get the time to look at that. So what I'm looking at here now is a finance lease on movable assets, not immovable property. It's not scoped into Part B of an ICA. So let's then have a look at what does the definition say. There's a Part A of an ICA in the VAT Act. And the definition say it doesn't apply to fixed property and operating leases. So it doesn't apply to operating leases, because in operating leases there's no finance. So we're happy with that. It only applies to movable assets where there's finance arrangements and the leasing of that asset under a finance lease. Part A, I'm not going to deal with it. In essence, talks about a credit sale on a suspended terms. So that's what broadly Part A of the ICA deals with. Part B deals with the finance lease, the one that we are discussing now, and there are 5 rules to basically fall into the definition and to the scope of an ICA for that purposes. And the 5 rules are that there must be a price payable in the future over installments, which is normally the case with an ICA. And we see that interest is there. Remember, one of the triggers that I told you, the talking points of the triggers is going to be that we pay interest. The total price must be greater than the cash value. The cash value is excluding finance, but including that. So obviously, if my total price is greater than that, it means there is interest again. They're reaffirming that this contract has interest. The lessee is entitled to use the asset for at least 12 months. So if your asset is not used for 12 months, it can't be a finance lease. And the lessee accepts full risk, or the lessee in some cases accept full risk, and further conditions need to be met. But generally, these are the implications, or these are the scope requirements to fall into finance lease. And if that is the case, the implication is going to be is that the lessor is going to have to declare full output tax upfront on the early of delivery of payment on the full cash value. The interest we're not worried about, because that's going to be an exempt supply, and the buyer is going to also be entitled to input tax upfront. Now let's just test the logics. I told you this is a cash cow for SARS, right? So think about the logics, right? The most common finance lease in the market, guys, is what? Is a motor car. That's the one that's most commonly finance lease. The bread and the butter of a finance lease, if you go in the markets, is a motor car. So if we did not have this rule, SARS would have only got from BMW, who sells the cars on the finance lease, output tax every month on the installment when the repayment is made to the BMW or the dealership. But by this special rule, what they are doing is they're ensuring that they get the full output tax upfront on the whole contract on the early of delivery of the first payment on day one upfront, right? I said it's a cash cow. Think about the buyer. The buyer in all case likelihoods is going to be individual. In most cases, it's individuals like me and you. We are not VAT vendors. We can't claim any input tax because we're not VAT vendors. So what SARS has done is they basically just made sure that the most prevalent finance lease in the market and arrangement, they've made sure that they get the full output tax upfront. very smart and a lot of effort that goes into the thinking and the policy. You think these rules are just made up like that. It's not just made up like that. I can tell you that they're very smart people at SARS when they write the legislation. So you can see there's a lot of thought process that has gone into this arrangement and the thinking behind the policy design of the VAT Act as well. So let's have a look, circle back. So what's going to be, we're dealing with the finance lease, we're dealing with the lessor still. We know the VAT implication is that the lessor must declare full output early of delivery and payment. The lessee is going to claim full input early of delivery or payment. So they're not worried about the term of the lease, and they're not worried about calculating and getting the VAT monthly. They want it upfront. They will even give the buyer the input upfront, and they'll match it and say full input, full output. We're not worried about it. But in the end of the day, like I explained to you, I think they do score, because the number one leasing arrangement in the practice is a company car. It's not a company car, but it's a car that me and you buy as individuals, and we can't claim any VAT on that in any case. So that is a problem. And even if it is a company, it's a motor car is defined, so the company can't get the input tax deduction. So it's all waxed very nicely, all in favor of SARS, and they always get the full output upfront, as you can see. So let's then look at the income tax implications, because we know that that implication is full output upfront. Now, what is going to be the income tax implication is that the lessor is going to receive monthly repayments on leasing that asset out to you. Remember, they're still the owner of the asset. They're the ones that legally own the asset. They haven't sold it to you. They're leasing it out to you. So they will get monthly rental incomes that they receive. They're going to pay gross income into it. And remember that we have declared the full output upfront. So each rental, what we need to now do is we need to calculate the total output VAT that we paid upfront, and a little bit of that output back to this monthly rental where it belongs. So we're going back to normality, if you want to call it, because for tax, for VAT, what we've done is we declared the full amount of the output upfront, but now when we claim for income tax, we only have to pay income tax on the monthly rentals that we receive. X VAT, obviously, we need to take out the VAT, but because we've declared the full output, we have to run an accounting formula to say, this is the total amount that I paid in output. How much belongs to this monthly rental that I received now? And I will basically do an apportionment and say, okay, what is the installments received? It shouldn't be paid, received in the tax period, divided by all the installments that I must receive in total. And I'll take that apportionment of the total output that belongs to this tax period that I'm declaring income tax on. And then very importantly, so that we're going to strip out the VAT from the rentals received, and we're going to declare that into gross income. And very importantly, what we see is that that leases are also not scoped in for Section 24J, which technically means that in this monthly repayments or installments, there's a little bit of capital, there's a little bit of interest, as you know, and we've taken out the VAT now. We've just done a computation to take out the VAT. And therefore, you don't have to run Section 24 on day-to-day basis, because its leases are not scoped into Section 24J. This is a finance lease. So we're claiming the interest as part of the lease premium, or we're actually paying income tax on the lease repayment, which includes interest on the into our tax computation, obviously. So we take out the VAT, but included in this monthly rentals that we are receiving is a little bit of capital and a little bit of interest. And the point that I'm making and belaboring is that that interest is not run on Section 24, which is day-to-day basis. Don't forget that the lessor is the owner of the asset. Therefore, they will be able to claim capital allowances on the asset. What about the lessee, guys? The exact opposite will basically happen in the hands of the lessee. Firstly, is the definition of Part B. They can claim the full input tax upfront on the cash value. Consider apportionment ratio. Make sure you got the finance lease as a valid tax invoice. Interest you don't worry about, because it's an exempt supply. So whatever we do on the lessor side, we flip and do a mirror image on the lessee side, but here we're claiming a deduction instead of actually receiving income. The same thing we see on the lessee on the income tax side. We're going to, instead of paying income tax into gross income now, we're claiming a Section 11A deduction by the lessee. And again, we're going to have to take the total input that we claim, apportion it to the monthly rentals that I'm trying to pay or claim a deduction on. And we're going to claim that ex-VAT, but including interest, obviously, because leases are not scoped into Section 24J for interest purposes, and I will not have to then do day-to-day for the leases. Don't forget, at the end of the finance lease, guys, if there's some kind of Section 85B recoupment, be careful, be aware of that. If the asset, if you bought the asset, and it's common in the finance lease that you may buy the asset, and or if you didn't buy the asset and you continue to lease it out at a very low rental, we're going to have a Section 85B recoupment that's triggered. And then lastly, we've got about 10 minutes. Danny, Stan, I just want to check if there's any questions. If not, I can then deal with the last example to bring this discussion to a close. Danny, if you can maybe let me know if there's any burning questions that anybody have. We've got about 10 minutes. If not, then I'll take this opportunity to just close out with a short example on the finance lease. I don't see anything on the chat as well. So what I'm going to do is I'm going to continue, guys. So let's have a look at this example. It's going to bring together the whole discussion on finance lease that we've just been having. So let's assume all amounts of VAT inclusive where applicable. And we've got the background given to us. We've got this individual, a group of friends, it's South African tax residents, electrical engineers by job title. The friends incorporate the company SolarX on 2 January, let's call it this year, after registering the company with the CIPC. If they're lucky, they can get it through. The SolarX is based in Bellville in Cape Town. SolarX is a tax resident of South Africa. The business consists of selling, leasing, listen to this, selling, leasing arrangements, and installing solar power units for business and households. They are registered Category B VAT vendor with the South African Revenue Service, and the year end is 31 December. Then we have solar leasing, because we know we also lease out packages, and let's look at what the transaction, the leasing arrangements are. Due to the expensive nature of solar systems, SolarX, in addition to selling, also leases services of solar power kits using a package system that includes 3 options for customers. Installation cost is a separate cost and is charged at 2% of the total cost of the power kit. SolarX also produces and manufactures solar batteries, so that's their trading stock, as they have much longer battery life range of about 5 to 10 years. Lithium-ion batteries are also safe and maintenance-free, and the company uses off-the-grid inverters for the Rain package and a hybrid inverter for the Rain Plus and Central packages. So we can see there's 3 possible rental or leasing packages that they offer on the market. All plans allow the customer to enter into agreement with SolarX for at least 24 months. Finance charges are included in the agreements, guys. If we test the scope of an ICA Part B, remember we had finance charges. We had that the agreement must be more than 12 months. We already seen 2 of the scope requirements coming through. The conditions in the agreement state that SolarX will be responsible for the insurance. So it's smelling like a finance lease. Obviously, it's a lessor's asset. They must take the insurance. The customers will be liable for any repairs and maintenance. Makes sense, because again, it's smelling, feeling like a finance lease. The repairs must be with the person that uses the asset, and the maintenance of it. The agreement gives the customers an option to purchase the solar kit at 10% of the final residual value. Be careful for that, because that's a possible Section 85B recoupment. Remember, because we can buy this asset at the end of the term. They give us the 3 plans, the Rain package, the separate installation costs, and they give us the total cash value of the Rain package, the Rain Plus package, and the Central package, and they tell us what it can actually power up if you buy one of those packages or rent out those packages or lease it out. This is what you're going to be able to power up in terms of your solar power. And these are the 3 arrangements, but very importantly, we've got the cash value over here X VAT, which is important for our calculation purposes. Now here we get to the actual transaction. On 1 Feb this year, Solar X was approached by Samantha, a potential customer looking for solar power unit to be installed in her house. And the installation of the panel took place on 14 Feb this year, and she opted for the Central Plus lease package. So if we circle back, that's the Central Plus, the bottom one. She's taking the top of the range one. The cash value is going to be 78,000. There's also 2% of the total cost that she's going to have to pay us for installation. So there's our total cash value, excluding finance costs. And we know that, and we see that she's going to basically now enter into this leasing arrangement. The additional information is that the company only transacts with VAT vendors unless otherwise indicated. They have valid tax invoices. We can assume that as well. And they've got sufficient expenses or records for all the expenses that they've incurred. We need to discuss the tax implications of Solar X, the client that you're dealing with, in respect of the leasing transaction with Samantha for this current years. And let's have a look. We're going to start off with the VAT implications, which we went through. And we said, because the first thing we need to do is to test whether this is an ICA Part B of an ICA. If that is the case, the implication is that the lessor, the company, must declare full output tax upfront on the early of delivery or payment. So we start off with a test. We see that the lessee is entitled to use for at least 12 months. The agreement is actually 24 months in our example. The repayments exceed the cash value, and therefore there's finance charges. So if we take the repayments times 24 compared to the cash value, we see it's greater. The lessor accepts full risk of maintenance. The lessee accepts risk relating to repairs and maintenance. Therefore, the conclusion is this is an ICA in Part B of the VAT Act. The implication is that on the early of delivery on payment, 14 Feb, remember we installed it on 14 Feb, the supply, the customer. On that date, they're going to have to declare the full output tax on the cash value to SARS. And obviously, in addition to that, we're also charging them installation costs, 2% of the cash value. We'll have to declare output VAT on the installation costs as well on that 2%. Don't forget that there's also finance charges in the actual transaction. That's an exempt supply for VAT purposes. We're not worried about that. What about the income tax implications? If we look at the income tax implications, remember that I am as a lessor, I'm leasing out this asset, and therefore I'm entitled, or I must basically pay income tax. Let's take that monthly lease rentals that are basically receiving, and I've received it for 10.5 months because we entered into it midway through Feb. There's some monthly rentals that I got, but in there, remember, in there, there's VAT, there's capital, and there's interest. We just declared the full VAT upfront, so we have to take that full VAT of 10,000 upfront, apportion it to the period that we are actually declaring and paying income tax on. So we received 39,000, but our total payments on the lease term is going to be 89,000. Therefore, a portion of the 10,000 output that belongs to this 39,000 is 4,492 rand. We will minus it from the 39,000, and we will declare that as gross income. And then don't forget that we also have to pay income tax on the 2% installation cost that we get. We don't worry about Section 24J because we're not going to do day-to-day basis. In this income year that we got, there is interest as well, an interest element, which is being declared, and we're paying income tax, but we're not worried about Section 24J for that purposes. We will just deal with it on an accrual basis. And don't forget, because this is an asset that we as a lessee, or rather it's a lessor own, we're the owner of the asset. It's a finance leasing arrangement. We can get an allowance in terms of Section 12B or 12B Cap A, depending on the dates. You'll have to basically consider it, and you can claim that accordingly. So that is, that is where we've come to, guys. I just want to big picture give you all the sections that we've covered today. In terms of capital allowances and deduction, the lessee can get a Section 11A if it's an operating lease. If it's a finance lease, Section 11 small f. Leasehold improvement, 11G. Excess spend on a leasehold improvement, Section 13 building allowance. Section 12N we didn't cover, but it really relates to where lessee undertakes leasehold improvements on government land, which is not taxable, obviously, because the government will not be taxed, and this deems then the lessee to be allowed a deduction. So that's a very special rule. And then we dealt with Section 8.5, the recoupment, which we created an awareness for you that be careful at the end of the term of the lease, if we get in all these deductions, that there isn't a sort of deem a recoupment that is triggered in the hands of the lessee. And don't forget, in the hands of the lessor, we then also looked at a special inclusion under section or gross income paragraph G for the lease premium, leasehold improvement inclusion under section or paragraph H of the gross income. And finally, if we have a premium inclusion or leasehold improvement, we can get a deduction under 11H for the lessor, which more or less should be equal or to the inclusion. But be careful of the anti-avoidance that may come through over there. Stan, I see you coming through. I just got to the end of the. How's that for timing?
Your timing couldn't be more spot on. Obviously, the bell will now ring. But most interesting afternoon. I'm sure that everybody will want to get a copy of the recording because it's very complicated. Need to run through it again, I'm sure. Thank you so much for your time, Mania. You've been an excellent presenter, and you make it very clear to everyone what's going on. Thank you to everybody for joining us. Your certificates will be on the way to you. Next month we have Jackie Aronsa, the mid-year tax update, and of course we're interested to see. We've been talking about that here, and I'm interested to see what the outcome of the negotiations are and where we end up with that. So looks like we're in for an interesting couple of months. But thanks once again, and everybody can have the rest of the afternoon off. And thank you.
No, thanks for having me, Stan. Thanks, Danny, for facilitating as well. Thanks so much. And thanks for being here, guys. Excellent to be here. Thanks.
Cheers, everyone.
Cheers, everyone.